So thank you very much. My liberal arts education comes from Brown, so I guess Columbia was kind of our rival, I guess we would say, maybe not, maybe Cornell. But when I am assuming some of your ages out here, when I was your age, I was just trying to figure some of this out. And what I'm hoping to do in this time with you is accelerate your learning process by changing the way that you think about markets. And so this can be very, very powerful, not just for financial markets. This can actually be extremely powerful for entrepreneurship. Figuring out what it is that needs to be built, what is the market missing, and how do I build it, is something that I believe that you can get from my course. Now, I think that there was some talk about addressing cryptocurrency trading, which is really exciting. But when I heard that that was what this group was interested in, I really sort of pushed back slightly. And the reason why is because most people do not have a basic foundation in market structure. And what this course is, I call it Financial Market Structure Dynamics. It's the study of why markets work. And so one of the things I'm going to warn you, because I know that some of you are eating, and that's fine, but this is not me talking up here for 2 hours. This is not how this course works. This is an interactive course in which I'm going to ask you questions, and I'm really listening to your answers, because the way that this course works is your fellow students are going to learn from you. Some of the questions that you ask, some of your thinking, and we're going to work through stuff together because I want to make sure that you have this foundation in the way that you approach your thinking process around market structure. If you've got that foundation, then boom, you're cooking with gas in terms of being able to evaluate what's going on out there, come up with some of your own ideas, and also predict the future. All right, so this course has several modules. I'm going to start with this basic module because we need it to kick everything off. And then, depending on what your interest is, we can kind of jump around a little bit. But the first thing that I really want to talk to you about, and want to get in your heads, because this is really important for understanding the rest of this course. The first question I have is, what is a market? Sorry, I gave a preview. I won't make that mistake again. I'd like someone's view. What's a market? Yes?
It's a mechanism for price discovery.
Okay. Any other answers? Yes?
Place where buyers and sellers can come together.
Physical place?
No, I mean, not necessarily.
Okay. Any other answers? Yes?
A place that facilitates transactions or exchange of goods
Okay.
or services.
Again, a physical place, you're thinking market is somewhat data, and that's what a market is, or being able to see data. Well, a market is actually a social arena where buyers and sellers meet. Now, they can meet virtually or they can meet physically, but these are three different markets. We recognize these two. This is the futures pit, maybe 60 years ago, okay? But one thing I want you to start thinking about, when you walk into a supermarket, do you know how it works? You do, don't you? You know what you're supposed to do, right? Great. You know who doesn't know how it works? Those little kids that are getting spanked in supermarkets, right? They don't know you're not supposed to just take stuff off the shelves and start eating it. Flea markets, you go to a flea market, you know how it works. Here you might have to figure it out, but one thing I want to make clear here, there's no rule book. You learn as a human being how a market works basically by observing other human beings and being informally taught. And so when we think about a market's really nothing more than a system of shared rules, which can be laws or collective understanding, pretty much held in place by custom or explicit agreement. That's what a market is. Markets have been around since human beings have been around. Of course, they started out as being physical places where people were meeting, but you have to think about the rules of engagement in a market. How did we get here? How does this person know what their role is and that person knows what their role is? And so when you're thinking about markets, and it's going to make it a lot easier for you to understand financial markets, I'm going to translate this collective understandings piece. What really markets are culture. And when you look at markets as culture, like the same way we kind of look at social culture, culture is different everywhere. There are quirky things that we do in markets that kind of resemble quirky things we do culturally. So as we begin to examine the structure of financial markets, we must never forget that financial markets are these cultural institutions. They're not information systems. They're not, I mean, markets can evolve to have robots in them, but even those markets are cultural systems. And the reason why I mention this to you is because when you start to examine financial markets, or really any marketplace, there are going to be some things that don't make sense to you. Why do they do it this way? It's culture, man. The same way we look back at history and we say, why did they do that way? It was cultural. One example I can think of, like a cultural thing that's changed, where we sort of look at it today and we're like, this doesn't work anymore. Arranged marriage is a cultural institution that takes place in some areas of the world. It used to be something that was ubiquitous across the world. But as the world started to change, as technology has started to change, as people started to become cohabitate closer together, arranged marriage didn't make sense anymore. I'm mentioning this to you because as markets evolve, the thing that you've got to pay attention to is the culture shifting? Is the culture changing? Because when the culture starts to change, that's when new ideas can actually start to be incorporated into the marketplace. Now, for everyone who's interested in Bitcoin here, right? We're talking about cryptocurrencies. We've seen a cultural shift happening at warp speed around digital currencies. Warp speed. We've gone from Mt. Gox to people talking about Bitcoin literally every day in the news. So the acceptance of a new idea in financial markets, or really any market system, is going to be based on, is the culture ready for it? Is the culture ready for a shift? So how the rule systems for trading are maintained defines the structure of a financial market, just kind of going back for a second. And there are two main groups here. I'm sure you've all heard this, you're business school students, you've heard of over-the-counter, right? Okay, and you've heard of exchange-based markets. Why do they call it over-the-counter? Does anybody want to take a guess? Like, where does this come from? What does this mean?
Someone's facilitating at a counter, like a trade between two parties?
So, I like the last part of what you're saying, a trade between two parties. Because the imagery of over-the-counter is, I'm on one side, you're on the other. And that actually is a pretty good description for what's happening with over-the-counter trading. Me and you. Okay? Now, over-the-counter as a loose term, right? It really doesn't much define anything. There's no standardized mechanism that makes something over-the-counter. Exchange-based markets. Does anybody want to take a crack at, like, what is an exchange-based market? What is an exchange? Yeah?
Just a conjecture, like many buyers and many sellers.
Yeah, but the number of people involved in a marketplace doesn't then make it an exchange.
Are you discriminating between a transaction between an individual and like an enterprise versus two individuals or two enterprises?
No, I'm merely talking about the rule system, the structural rule system set up that determines how are we going to trade. What rules are we playing by? This has a different rule system than this one. Yeah.
So exchange, you basically have one layer, so all the sellers and the buyers can see each other's price and cost. But for the OTC, you have like different layers, and just like in the main systems, they have bilateral, but the clients, they need to buy and sell through those agencies or brokers, whatever.
Good answer. Not necessarily the correct answer, but this is, I'm trying to get a sense of your thinking, yes.
I was going to say exchange kind of sits in the middle of buyer and sellers, where buyer and sellers don't have to necessarily.
Not exactly. But we're going to go, yes, let's go.
It's centralized versus bilateral.
Getting close.
Like more information in exchanges. Information is kind of withheld. Like our information is not very transparent in over the counter, and it's supposed to be very transparent in exchange.
Okay, yes, you want?
So there's negotiation with over the counter, but exchanges.
All right, we're going to get into it because these are all good answers. But the first thing I want to ask you, which came first? The exchange system or over the counter? OTC, that's right. All markets started as OTC. Think of just OTC as informal. Just totally informal, right? So what we're going to do is we're going to compare the differences, the major differences between OTC markets and exchange-based markets. So the first thing we're going to talk about with OTC markets is that OTC markets from a rule set standpoint, and when I say the rule set, what we're talking about is how do you get to a trade? How do we consummate a trade if we're trading something OTC or if we're trading something on an exchange? Now, the rule set for consummating something OTC is a principles-based rule set. This is the most common type of rule set that's out there. Can anybody out here, we don't have to talk about financial markets, can you name a principle that you live by? What's a principle that you live by every day?
Honesty.
Honesty, that's your principle. Great. Are you always honest? Okay. What about if you're eating dinner with your parents? Can you put your feet on the table? No, you're not, right? Parents are going to get your feet off the table. This is because you have a principle-based rule structure. You're not supposed to do that. 99% of what we do as human beings is based on principles that we either observe around us or we're sort of explicitly told, like, don't do that. And if any of you are like starting, are either serious about someone or engaged or married, right? That first time you meet your significant other's family, you're nervous. You want to know why you're nervous? You don't know their principles. You don't know what the rules are in their house. And so you're tight, right? Did I do something wrong? So OTC markets function that way. They're massive markets that literally observe an invisible rule set on how we do trades. Custom is really binding that rule set. Now, the second thing about an OTC market, and some of you said it, you guessed it, I think OTC comes from the fact that most of the trading, if we're talking over the counter, it elicits this imagery of, hey, it's just me and you. And bilateral, right, it's just two people in a trade. Now, settlement is mostly bilateral, but I'd like somebody to please volunteer, somebody who feels they have a good handle on what settlement is. Okay?
The process in which two parties have agreed and the transfer of their funds, how you kind of get to that part where the two parties' funds transfer. So it's the settlement is the aspect of agreement that it can swap between hands and the trust between that.
Close. Let's clean it up a little bit. How would you describe to an alien that beamed down from outer space settlement for eBay?
All right, so someone has posted an item and someone is willing to buy it.
Mm-hmm.
So settlement is the trust that when you pay someone, that item is going to come to the buyer.
When's the eBay trade settled?
At purchase.
Is that true?
I guess it's settled at
Who had an idea?
I'd say it's delivering the goods in exchange for the money, I guess. When that happens.
Bingo.
at delivery.
That's when a trade is settled. We can talk about doing trades. In fact, this looks a lot like the structure for when I showed you those futures pits. You know what would happen in the futures pits, the way that it worked? All of you people would be trading with each other, right? You'd be shouting across the room. I would be sitting in the middle of the pit, wearing goggles. Why am I wearing goggles? Because you're throwing pieces of paper into the pit that confirm you are doing a trade with him. You guys look at each other, exchange hand signals. Now you've done a trade. Hey, I'm buying at 100. I'm selling at 100. We're selling 50 bushels of cotton, whatever it happens to be. Then you throw your settlement card in. You throw your settlement card in. I'm supposed to be collecting all these cards, putting them into a place so that at the end of the day, the terms match, then it can settle. Now that process for OTC markets is mostly bilateral. And the reason why I'm emphasizing this with you is because when we're talking about securities markets is like, it's an actual thing, right? Like back in the day, if you bought a bond, you'd have a physical piece of paper. Back in the day, if you bought a stock, you'd have a physical piece of paper, right? So it's actually a thing. There's custody of the thing. Finite is settlement. I mean, settlement is finite in securities markets. Once it's settled, once you do that trade on eBay, you buy that Fabergé egg you wanted, you don't ever really deal with the person anymore who sold it to you. It's finite. They got your money, you got the egg. I'm mentioning this to you because in your examination of things like the 2008 financial crisis, this was a settlement problem because we're talking about a derivatives contract. And what a derivatives contract is, a derivatives contract actually never settles. It's an ongoing perpetual relationship between the buyer and the seller. So it's just a difference here because when you do a trade that has finite settlement, boom, that's it. There's no more risk that the trade will break. When you do a derivatives trade, the trade absolutely can break and disappear. And it can break and disappear if the other side of the trade, something happens to them. The same way, if you crash your car on the day that your insurance company goes under, nobody's giving you the money to be able to fix your car. All right, so one thing you should know about OTC markets, every single product out there trades OTC in financial markets. Everything has OTC trading activity. In fact, believe it or not, 60% of single stock US equity volume does not trade on an exchange, which is shocking to us because I think when we think of the US equity market, we're like, everything just trades electronically on an exchange. Why wouldn't it? But that's actually not the way markets really work. All right, so when we're talking about an exchange, what I'm first going to tell you about an exchange is nothing but a collection of rules. It's just everybody saying, look, all right, you're going to trade on this exchange, here's the rule set. This is how it's going to work, all right? The same way that you've got a school handbook. You've all read your school handbook front to back, right? Right. So, but what you know is when it comes to the enforcement of rules, exchanges, up until about 20 years ago, the enforcement of the rule set was all done by human beings. So guess what? They were really principle-based markets. Now, as computers have come into exchanges, they've become rules-based systems, meaning you must follow the same, the sequential pattern in order to get to a trade. If you don't follow that pattern, there won't be a trade. So can any of you think of an example in your life of something that's a rules-based system that you must obey every day? Or something that you're familiar with on a daily basis? Rules-based system that you live by.
Driving.
Driving?
I don't drive right now.
No, you don't drive right now.
typically.
Okay, so what's the rules-based system that you live by when you drive?
Highway rules or state rules.
So you never speed.
Again.
All right.
Not always.
See, that's what I mean. The rules are out there. You see the sign, go 55, and you're going 62, right? That doesn't happen on exchanges. Computers regulate all the behavior, so you can't do that. Can somebody give me another example? Yes.
I don't know, gravity?
Yes, it's a natural law. Yes, exactly. We can go up on the roof and test gravity. What about logging into your phone? If you put a code 1,000 times in a row and it's wrong, will your phone just all of a sudden be like, ah, okay? No. It's the same thing in modern exchanges now. If you are not adhering to the rule set that is being codified by the technology, you will not do a trade. And just to show you how real this is, has anybody heard of Knight Group? Anybody? Yes. Do you know who they are?
It's market maker.
Yes. And so about 5 years ago, I believe it was 5 years ago, they had a mistake in their code. And they did a bunch of trades in a few hours that ended up costing them hundreds of millions of dollars. And so Knight, they said, oh, let's call the exchange. Hey, exchange, listen, we had a mistake in our code. It was a mistake. So we're going to break the trades, right? No way. You start letting computer systems absolutely manage the rules, then you cannot break away from that. You cannot make exceptions for that. And so that's why markets that are completely managed by computer systems start to get a little bit dangerous, because there isn't a human judgment factor as to how to handle the actual process of trading. Now, something else that you should be aware of, because I think it was mentioned, you were talking about an exchange, it's a bunch of people getting together. Well, if the trading in OTC markets is bilateral, the trading in exchange markets is multilateral. Can anybody describe to me what multilateral trading is? Give me a good definition that everyone can. All right, here's a, let's see how smart this room is. I've got 10,000 shares of Microsoft stock to sell. How many potential buyers could be on the other side of my trade in a multilateral transaction?
10,000.
10,000, all right, great. Some people have gotten that wrong. All right. Can you see how that works in a multilateral trade? I've got this big position to trade, and I can trade it by trading it with a lot of other people. There are multiple people that can be involved in the other side. That doesn't really happen in OTC markets. If I've got 10,000 to trade, I got to find somebody else that has 10,000 to trade, and that's how I'm going to get that trade done. So when we're talking about the efficiency of trading, exchanges, the ideology around it is like, let's support multilateral trading, okay? But when you have multilateral trading in a system, you also have to have a mechanism for settlement. So if this settlement's bilateral, right? This settlement system is eventually, you need something called central clearing. Does anybody know what central clearing is? Yes?
So the process in which the orders get filled. So you have, 10,000 shares, like in your example,
Yeah.
and you post it for a price. The process in which they fill those 10,000 shares based on the price point up until the total sell.
Well, when we're talking about settlement, we're talking about everything after the trade.
Right, so there is a party that is managing the bids that are being put in by the multilateral group of buyers and sellers, so that essentially clearing in that sense.
No, that would actually occur at the rules level of an exchange. When we're talking, sorry, you wanted to.
Yeah, so settlement would be if once the trade's done, actually matching who should get the shares and how the cash or the money should actually flow.
Exactly. Because if I've got 10,000 shares of Microsoft to sell, right, and I sell it to 10,000 people, can somebody describe to me what that would look like if we had bilateral settlement? What does that look like? What do I have to do now?
You'll go after each one to exchange a piece of paper.
How many times?
10,000.
And how many checks am I waiting on? 10,000 checks. See, when exchange-based markets started getting faster in the 70s, because they started adding some technology to them, little known fact, they used to have to shut down the New York Stock Exchange every Wednesday just to deal with the paperwork, because they didn't put in a clearing system. This is like mountains of paperwork. This is supposed to be delivered here, this money is owed there. Now let me give you something about central clearing that makes it a bit special. Now, if we're bilaterally settling my Microsoft trade, and if 1,000 people don't send me their money, have I done a trade for 10,000 shares? Now how many shares have I sold?
0.
No, 1,000 people didn't show up with their money. I sold 10,000 shares, but 1,000 of those people, I sold 10,000 shares to 10,000 individuals. 1,000 people didn't show up with their money. They never sent me their money. Have I sold 10,000 shares of Microsoft still? No, see, that's called settlement risk. I thought I sold 10,000 shares of Microsoft. And how settlement risk can really bite you? I sold 10,000 shares of Microsoft. Next day, Microsoft plummets 5 points. Hey, I'm out. I got out of Microsoft. I got my cash coming in a couple of days. Oh, wait. I only sold 9,000 shares of Microsoft because the other 1,000 did not show up. So trade breaks actually create a lot of risk in the system. And what central clearing does, the entity that's handling central clearing, the management of the payments and the delivery of shares, they say, I've got it. I'm responsible. If those other 1,000 people didn't make delivery, I'm going to make the delivery on their behalf, and I'll chase them. So trade breaks go away. And so you're going to hear a lot about markets getting modernized. They're talking about putting clearinghouses in and stuff like that. It's to really reduce this settlement risk piece that we just went over. Now, when we're talking about exchange, oh, sorry, yes.
I have a question.
Yeah, sure.
You just mentioned the centrally clearance, and I'm wondering that. So now, if we have the centrally clearance system, then does the risk actually lies in the centrally clearance?
Absolutely. So some people will argue that central clearing is just creating a bigger risk, because what you're effectively doing is mutualizing all the risk into one place. So central, if you look at the mechanics of central clearing, and if we had like 12 hours, I'd add that to this course because it's actually pretty interesting. The way that central clearing actually works is the house, the clearinghouse, must be capitalized by the clearing members. Hundreds of millions of dollars are put into the clearinghouse. And you, let's say we're all clearing members, all of us would have to put up a bunch of money to capitalize the clearinghouse. But you know what we also get? We're the only ones that can clear trades. And if anybody else wants to clear their trades and get the safety of central clearing, they have to clear the trades through us representing them. Think of it as like think of it as like a social club, right? And so there's money to be made in central clearing, and that what you have to do now if you're a market participant outside of the membership group is you've got to pay each time you clear a trade. And so the reason why there's all that money in there is because not only does a central clearinghouse step in if there's like a failure on delivery, if one of these people in this room, as a clearing member, actually fails, like you go under, the central clearinghouse has to have enough money to represent you to everyone else. So we're talking about a lot of concentration of risk, especially when we're talking about central clearing in markets that have trillions of dollars in notional, which is a lot of the derivatives markets that are out there. Interest rate swap clearing is something that's now massively big and it's being centrally cleared. All right, so when we're talking about what changed on an exchange, there are select products that trade on an exchange. Not everything, only a couple things. And I'm going to explain to you why that is. But something can trade exchange and OTC. Just always know that. Here's the thing, nobody's forcing you as a market participant to trade on an exchange. You're making this decision on your own. No one's forcing you to trade OTC. But you're making the decision of where you go based on something. And this is a question I have. Can anybody guess? Why would someone choose an OTC trading strategy as opposed to using an exchange? What's your guess?
I missed the question, sorry, I was staring at this.
No problem. Why would somebody choose to go with this archaic, out of date, like principle-based, bilateral environment to do a trade as opposed to trading on these exchanges that now have like computers and central clearing and multilateral trading? Like, why would you do that? Like, one's better than the other. I can come back to you if you want. Come back. Anyone else who wants to take a stab? This is a hard one. All right, go ahead.
Yep. So I think two things. One, all products are not traded on the exchange. So if you want to trade something outside.
Okay, so let's say it can be traded on the exchange.
Yeah,
you got me.
Yeah, and the second thing I would say is that there is a price, like the willingness to pay may differ across participants. So on the exchange, you would typically have one rate. Let's say you are able to find a participant who is willing to pay much more than that. Let's say in the case of a PE transaction or a strategic, like buyer buying an asset, so like you can go for like 20, 30, 40% premium, then you would probably do a notification.
You're close. You got it kind of backwards, but you're close. Your thinking is correct. Who wants to take it? Who's really confident? Okay, let's go.
I think you may want to get to know your counterparty.
I like that. I like that. Why do I want to get to know them? Why do I only just want to trade with them?
You want to understand who is going to co-invest with you in a company, for example. Then you want to understand.
It's a very romantic view on markets. You're very close, all right? Anyone else?
I mean, kind of along those lines, I think movement in the market, so you're able to go and make a trade without fluctuating the price. So
Bingo.
Yeah.
Bingo.
like dark trading.
This is what I mean. When we're talking about the theory of market structure dynamics, what I'm trying to break down for you, and this is powerful stuff, I'm not going to tell you how a market works. I haven't taught you anything there. I'm going to tell you why it works this way. If you understand why it works this way, you're like a Jedi Knight out here. Because I'm telling you, on my 20 years experience on Wall Street, people running massive businesses, people who are setting regulation, they don't know why. A lot of the decisions they're making are like, I don't know, I mean, because they said it or somebody believes it, but they don't actually know the dynamics underneath. Yes?
Excuse me, I have a question back to the previous slide. So what if an exchange went bankrupt? So also it's like very few or like seldom, but
don't confuse two things. The exchange itself is a separate entity sometimes than the clearinghouse. The exchange, we could all right now sit in the room and figure out how to create a Columbia Business School exchange. And all we're doing is saying, okay, this is how it works in terms of trading, and these are the membership fees, and in order to maintain good standing as a member, and these are the things that we're going to trade here. An exchange is just putting the rule set down on paper.
So you mean the exchange doesn't hold the risk, but
no.
The clearinghouse holding the settlement?
Yeah, see, the exchange is the top layer of the trade. It's like getting to the actual trade. It's a rule set for agreeing to a trade. The settlement piece can be decoupled from the exchange altogether. Something can trade away from the exchange. And just like, here's the extra credit on this.
Yeah.
So commodities futures, right? A futures product is a product that somebody makes up. Like for example, the Intercontinental Exchange. And the reason why the Intercontinental Exchange is like one of the most successful financial organizations out there is because they create the product, so now it's proprietary. You can only trade this futures product, this ICE futures product on the ICE exchange. Oh, and by the way, you can only clear it at the ICE clearinghouse. It's called a vertically integrated model, okay? In which everything is with ICE. And so they charge you here. Hey, they charge you to get access to do the trade. They charge you to basically reference the pricing on their proprietary product. And they charge you an arm and a leg to clear the product. So it's like, when people are thinking about markets, a lot of times people are thinking about just the trade. I'm going to tell you right now a secret. That's a bad business. If you're thinking of a business where, hey, I'm going to make money every time somebody does a trade, the good businesses are, I'm going to make money because everybody needs this data, or I'm going to make money because everybody needs this clearinghouse, or I'm going to make money because I figured out what mechanism is going to be essential to an actual trade happening across every exchange. So if we want to talk about Bitcoin in here, we can talk about it. But when I'm talking to you about what the opportunities are in Bitcoin, the opportunities aren't like, hey, let's start Mt. Gox Part 2. That's not the opportunity. The opportunity is figuring out what are the pieces of architecture that nobody's building yet, that everyone's going to need in digital currency markets. Those are the killer ideas. And the great thing about figuring out those ideas is if you know this theory of market structure dynamics, if you believe in it, then you can figure it out before everyone else. So the study of why markets work, we're going to start right now talking about it. And this isn't something, you guys can look this theory of market structure dynamics up on the internet. It doesn't exist. Why doesn't it exist? Because I built it. And the reason why I built it is because as I was building things in markets and studying history, I realized that there are problems where we're not able to get on the same page around how markets actually work according to a historically verifiable pattern. I'll give you an example of why creating a theory is so powerful. 500 years ago, if you were talking to someone and saying, hey, I think I'm going to figure out how to fly, right? What people were doing back then is gluing feathers to their arms and jumping off the roofs of their houses. We think that's ridiculous now. And the only reason why we think it's ridiculous now is because we know that you've got to know the theory of gravity, You've got to know the equation for acceleration. You've got to know aerodynamics, lift and drag. And it's only when those things are not only known, but accepted as theory, that then somebody could figure out, oh, okay, so this is how you do it. This is how you put these things together. So this theory is designed to create optimal market systems. How do you optimize a market? So the first thing to think about, and this is really, really important, okay, because this is like at the base of the theory, is that a market is really only comprised of two groups. Every market, liquidity buyers and liquidity sellers, okay? All good, right? Pretty simple. There's only one fundamental question that we just need to clear up. What the heck is liquidity? Anybody want to take a crack on what liquidity is? Don't be embarrassed because Paul Volcker doesn't know what liquidity is, in my opinion. So go ahead, let's go.
The liquidity is the assets that are willing to be traded. The amount of assets, I don't know if amount is a necessity, but availability of a resource or an asset.
Okay, yes?
Is the capacity of those assets of moving from one side to other very easy.
So how does one measure this capacity?
It's
Volume?
Yeah, what's your guess?
Spread, volume, breadth, depth.
That's how you measure it all? That's how you measure liquidity? Yes?
I think it's continuity of price and volumes that supports the transactions.
Great. So then what are the metrics that tell you that a market's liquid versus the metrics that tell you that a market's not? How continuous does the market have to be in order for it to be considered liquid?
So,
do you guys see what I'm doing? We're describing liquidity, but there's no formal definition here, and that's because liquidity is a subjective construct. It's really, really important that we accept that, because if we try to say that, no, you can actually, let me actually like define liquidity for you, it will never work because it cannot be applied universally to all markets. See, that's what somebody mentioned gravity in here as being a rule. Is the gravity in this room different than the gravity in Brooklyn? No. It's the same everywhere. So when we're talking about liquidity, I'm going to talk about liquidity with you in the same way in financial markets. We're going to talk about liquidity the same way that we would talk about liquidity if you were selling candy bars, in the 7th grade. So because it's a subjective construct, it's impossible to define. It's impossible to measure, and it's impossible to quantify, because it's your opinion. It's totally your opinion. Whether a market's liquid or not, it's your perspective. I don't know. So here are other examples, right? Blade Runner 2049 was a very confusing and boring movie. Who's with me on that? Okay, there we go. Oh, you're not with me on that, right? Okay, so check this out. Before you go to see a new movie, what do you guys go and do?
Rotten Tomatoes.
Rotten Tomatoes, right? Why? Because what are you looking for? You're like, you can't help yourself. You're looking for a freaking metric. I can't help it. I can't help it. Just, my wife will not let, like, anytime I'm trying to watch something weird on Netflix, she's like, let me check it on Rotten Tomatoes. Okay? I need a metric before I invest 91 minutes in this thing. Okay? Now, something you should think about, remember what I told you, the greatest ideas are the ideas that support the trading process. I tell you that Rotten Tomatoes idea is brilliant. Think about it. You guys are thinking about being entrepreneurs, you're thinking about doing really cool stuff. Rotten Tomatoes controls the movie industry. Just by doing what? Organizing the sentiment data. Brilliant. So here's another subjective statement. This financial market structure seminar is amazing so far. Some of you are in full agreement, some of you are not. But Amazing what? Is it a 92? Is it a 35? It's like when you are going to the Museum of Modern Art. You either love it or you don't, but there's no scoring system around it. So we're going to have to approach liquidity the same way that poets approach love. We're going to have to describe it. We're going to have to do a hell of a job. So liquidity can be best described as predictable immediacy. Does that clear it up for everybody here? Right? Great. Come on. We got to make it clearer. It can be described as a service of convenience. Depending on the market defines the service. And in that market, you've got two groups, okay? You've got somebody providing the service reliably and relatively quickly, and then you've got somebody who is looking to purchase the service. That's what liquidity is. Now, when we're talking about liquidity in a financial market, we're talking about the service of convenience to do what? What's the service that is being bought and sold in a financial market? That's the product. What's the service?
Price.
No?
The transfer of the security.
Close. You're so close. You're so close. The trade. Wait, who said that? Who said trade? Yeah. The service is the opportunity to trade. In financial markets, the service of convenience, the liquidity, is the opportunity to trade. Okay? That's what it is. Just it'll keep it straight in your head. It'll keep it simple. But I'm going to take this thing out of financial markets so you really get my point here. Because if you can crack this, you know more than Paul Volcker about liquidity. Here we go. In the real estate market, who is the liquidity buyer? Who is looking to buy? Well, first of all, in the real estate market, what's the service? What's the service that's being sold, bought and sold in the real estate market?
Space.
Space, but...
Access to space?
Yes, that's one side of it. What's the other side of the service?
Access to selling the space?
Yes. See, when we're talking about liquidity, the liquidity buyer is somebody who's looking to purchase the service of convenience to buy or sell a property. This is really important that you get that, because I think the way that a lot of people describe liquidity is, how quickly can I sell something? No. How quickly can I buy something is the other dimension. And let me tell you why it's so dangerous that we don't understand the theory of liquidity. Here's why it's dangerous. Does anybody know what central banks have been doing since 2008? Across the globe. Bank of Japan, Bank of England, ECB, what have they been doing?
Pumping money into the markets.
How have they been pumping money into the markets?
Interest rates.
That's one way. They've been doing something else. It's been a big departure from what they normally do.
Buying treasuries and mortgage backs.
And corporate bonds. And what they think is, we're supplying liquidity to the marketplace because we're buying everything that people want to sell. Funny thing, everybody else wants to buy. So what the central banks have actually done is they have reduced liquidity in the market. They've reduced the opportunities to trade if you're looking to buy corporate bonds, if you're looking to buy treasuries, if you're looking to buy mortgages. That market's not as liquid as it used to be. There aren't as many opportunities. So guess what's happened to the mortgage bond market, to the government bond markets around the world, and to the corporate bond markets around the world? What's happened? Does anybody know? Yes?
Prices went up.
Record prices have gone up. Is anybody aware that the German bond market has a negative interest rate? What a negative interest rate means is that for the pleasure of lending Germany money for 10 years, you have to pay money. That's because the central banks have been buying up, by design, all of the high quality bonds that are out there in the marketplace. Therefore, eliminating liquidity and artificially bumping up the prices such that when Germany issues debt, they say, nobody else has these bonds available, so I'm going to issue debt at next to zero interest rates, slightly negative interest rates, and people are buying it. So remember, the liquidity buyer isn't somebody who's necessarily buying or selling something. They're buying the opportunity to trade, in this case. Who sells that opportunity? Who sells the opportunity to buy or sell a house?
Broker?
Who said it? Broker? Yeah. This isn't a trick. This stuff is really simple. The broker's business, they make money making it convenient for somebody to do what? For somebody to do what?
Trade.
Buy or sell their house, right? Okay, so here's a little trick, and this is like what I love about market structure dynamics, because if you think about stuff in the way that it works, I'm going to ask you a question. How is a real estate broker compensated? What's the compensation model? This is not a trick. Who knows it? Compensation model for a real estate broker.
Commission?
Yes, exactly. Commission based on the successful purchase or sale of the property. So I want to ask you a question. Does the liquidity seller, this broker, do they take a lot of risks?
No.
Do they?
Yeah.
You do? Who feels they take a lot of risks? You do, yes.
You're not guaranteed anything at the end, and the risk is that you provide the service without being compensated.
That's very true. But have they put up a lot of their own capital to provide this service?
Well, you think of your time as money.
Yes, that's true. Yes, it's very true. But could you agree that the risks are relatively low? If we think about other businesses, let's think of this next business where the risks are really high. In the industry of food, sorry, I couldn't think of another way to say this. Who is the liquidity buyer? What's the service, first of all? What's the service? What are we trying to do? What? Eating, right. Eating what, though? Just anything? Who's a foodie in here? Raise your hand. Be real with me. You're a foodie? You're a foodie, right? So what are you looking for? What service are you looking for?
Good quality food.
Yes. Liquidity buyers, in this case, are hungry people looking to buy good quality food. And they also, some people are like, I'd like the place to be clean and things like that, right? These are your demands. Who sells this service? Good quality food on demand. Who sells it?
Restaurant.
Restaurant. Believe me, there's no tricks in here, so just shout it out, okay? So a restaurant sells it, okay? But I want to show you something, right? What is a restaurant? Oh yeah, go ahead.
Well, why don't this case, the liquidity buyer is the opportunity to look at all the delicious foods, and then the liquidity seller is kind of broker like Yelp or whatever, the meal box.
Okay, you're going fast, and I'm going to show you how this works. But your Yelp is a liquidity seller, but they are not a liquidity seller to the people who are hungry. Who are they a liquidity seller to? What service are they providing?
No.
What? No. What does Yelp do? Or what is, better yet, what is what are those ordering apps? Grubhub. Seamless. Grubhub. Who are they selling a service to?
Restaurant.
To the restaurants. And the service that they're selling is, what do you need as a restaurant?
The ability to sell.
What?
The ability to sell food.
Wait, somebody said a mechanism to do what?
A mechanism to get your food into the public.
Boom.
Marketing.
No, restaurant. Let me explain. This liquidity seller is the restaurant, right? The one thing the restaurant has to do, they've got to manage their risks. When you go to a restaurant and they go, here you go, they give you the menu, they've started risk management right there. What are they managing?
Expectations.
Well, not necessarily your willingness to buy. What does the menu do at a restaurant?
Limits the ingredients they have to buy.
Boom. You don't go into a Thai restaurant and order a cheeseburger. It's not on the menu. right? In fact, one of the things where you can tell where a restaurant's probably not very good, how big's the menu? If that menu's like 10 pages, I don't know, right? But they're handing you a menu, and this is a part of the process of risk management, because now they are defining what their inventory is. What do we have in the back that we're cooking up? This, okay? And I know some of you, or you go out with people who try to order shit off menu and they get really upset. Kind of because of this, right? Risk management, right? Just don't do that. So, let me ask you a question here. Relative to a real estate broker, are there more risks running a restaurant? Basically selling liquidity in the food industry, are there more or less risks than selling liquidity in the real estate market?
So I guess I'm not totally understanding this
Yes.
distinction between, so in this example, the
Yes.
liquidity seller is the restaurant and they own the food and they pay for rent and lights, whatever.
Yep.
But with the real estate, it's not the house owner that's selling to the individual, it's the broker. So of course you don't assume risk.
That's right, because and when I say liquidity, you should be translating that in your head and saying the service of convenience.
Yeah.
And for what the industry is, you say, okay, so in real estate, the service of convenience to buy or sell a house really quickly. Okay, that's provided by a broker. What do they have to have in order to do that, right? They've got to spend some time, they may have to advertise in the paper. But when we're talking about the food industry, liquidity in the food industry is the service of convenience to provide good food, right? The restaurant clearly does that.
But that to me sounds like the waitress, the chef, like as opposed to the actual owners who are not providing that.
Well, if we're all going to start a restaurant here, right, we'd have to actually figure out how we're going to deliver on the liquidity that's being requested. Remember, we've got a foodie over there. She wants to eat really good food. So we've got to figure out, how do we provide this service in this market? And what is it going to take? It's going to take rent. It's going to take hiring people. It's going to take buying the food in advance. You don't walk into a restaurant and they say, great, I'm going to go shop for the stuff and then come back. It takes actually making a major financial commitment to provide the service of liquidity in this space. And I'm hammering this home to you because something that's linked is the risk model, or the level of risk that a liquidity provider takes on, the person that's selling the service of convenience, it is linked to the compensation structure. Sorry, didn't mean to show you that. How do we make money if we were going to start a restaurant here? Like, in very basic, simple terms, how do we make money?
Take your cost and add a margin to it and price that.
Great. So when we hand that menu to our customers, do they know what the margins are? No.
They shouldn't.
Why not? Why not? This is what I love about market structure dynamics. What we're having a cultural discussion here, because there's no rule book on this, but this is the way we all behave. You don't go into a restaurant, look at the sirloin and be like, wait a second, time out. How much did you pay for the sirloin steak? Sorry, yes.
I mean, compared to the real estate broker model, you are the entrepreneur, you are the risk taker, so you want to maximize profits, and there's less risk involved as a broker, so the price is transparent and it's fixed, and here the price is not fixed because you're trying to maximize the profits the best you can.
I think both are trying to maximize profits, but the cultural arrangement between the liquidity buyer and the liquidity seller is quite different. The liquidity buyer in a real estate transaction, the person who's going to a broker, right? They're not okay with an undisclosed markup. Just give me the dirty price after you've charged your markup for your services. They need explicit clarity on exactly how much money you're going to make as a broker. And they demand that clarity because ultimately, you're not on the hook for a lot of risk. Now, in the restaurant game, we've accepted as liquidity buyers, we're hungry people, we've accepted like, okay, it's just an undisclosed markup. So this has happened to you when you've gone out to eat, right? You've gone out to eat and it's been a really expensive restaurant and you'd be like, the markup was too high. The food was okay, it wasn't great, right? Like when you go to, I think Nobu's shut down right now, but if somebody's like, hey, we're gonna go to Nobu tonight, I'm paying, your expectations are up here. Because you know you're being marked up to death, right? But you're also expecting the quality to be really, really high. So if Nobu tastes like convenience store sushi, you're gonna be like, what's up? The other thing you have as a liquidity buyer is, remember, it's predictable immediacy. The times in your life where you've probably been most rude is when you've ordered food at a restaurant and it took like 45 minutes or an hour, right? Because you're like, hey, I'm not paying all this money to wait. Where's the food? And you know what you're also not paying this money to do? The dishes. Clean it up for me. That's the full service. I want high quality food predictably, quickly, and I don't want to have to move. And I'm okay, I'm okay paying an undisclosed markup for that. And let me tell you something about an undisclosed markup. There are going to be times where you actually don't want to know. If the markup was disclosed to you at fast food restaurants, I swear to you, you would never eat there. Because you'd say to yourself, how is it possible that McDonald's can make a hamburger for 8 cents? This can't be a hamburger. So I don't want to know. I don't want to know. Oh, it's only $1? Great. The reason why I'm hammering this home and how it relates to financial market systems is because people who are providing opportunities to trade, depending on the level of risk it takes for them to do that, the compensation model is impacted. There are some products in financial markets where it's an explicit commission for someone to broker trades. There are some models in financial markets where there is an absolute undisclosed markup in terms of exactly how much money the liquidity provider made on this trade. And where financial markets, I think, are in trouble in certain areas is when the regulators start trying to engineer the compensation model and they're not paying attention to this. So I'm going to give you an example of that. This last example of this. And I'm going to beat this into this analogy like a dead horse. But here's the deal. Okay. You need to get to the airport, right? Talking about the transportation industry. I'm just trying to bring it together a little bit. So you're clearly a liquidity buyer, right? What are you looking to buy? The service of convenience to get from where you are to the airport. Could you walk to the airport? In theory, yeah. Go ahead, walk to JFK. You absolutely can do it. Nobody's saying you have to take a taxi, but you do take a taxi. You pay for the service of convenience to get you to the airport. That's what you're paying for. That's the liquidity you're paying for, okay? You're not paying necessarily to get there. You're paying to get there conveniently and quickly, all right? Now, who sells this service? Who's going to take you to the airport?
The owner of the medallion.
Yes, it's a very smart answer, but just very on the surface. Who's taking you to the airport? The driver, right. The taxi cab driver, right? Now, first thing I want to ask you, when you get into a taxi cab, right? First thing I want to ask you, you're going where you want to go, right? The taxi cab driver isn't like, I got to pick up my brother first, or I got to stop and get something at home. I'm mentioning this to you because liquidity sellers are often, if not always, responding spontaneously to the needs of the liquidity buyer. That's why there's a menu at a restaurant to have some level of control over that spontaneity. And actually, some cab drivers do maintain some level of control. Who here has gotten to a taxi and said, hey, I'm going here, and the taxi driver's like, yo, get out. Right, okay, they're like, no, right? What they're saying to you is, I don't get compensated enough for that, okay? So, what is the compensation model for a taxi? How do you make money? Is anybody here driven for Uber? Nobody? Okay, if you were driving for Uber or if you were driving for a regular taxi, how would you make money? You personally, how do you make money?
Tips.
What? Tips? So somebody said you don't? Okay. Actually, in a very sad way, some medallion owners are committing suicide now, but what's the basic model for making money as taxi cab drivers? Yes.
Miles and time.
What?
Miles, I mean the driving miles times like unit price plus the waiting time times the...
Right, so what are you having to buy, how much money do you have to put into the business in order to provide this service? What do you have to buy? You have to have the car, right? The gas.
The license.
The license. Those are all the sunk costs. So the way that you make money is when you drive someone somewhere, you're charging them a premium, right? Okay, but do you have free will to charge them whatever you want? Is it an undisclosed markup? No, it's a heavily regulated. It's a disclosed service fee. It's disclosed to the point where you actually see it on the door of the taxi cab. Can anybody take a guess as to why they do this? Why would they do this? What could happen if you don't have this in place? Yes?
Because like the cab driver, it's a perfect competent market. So if they don't have like agreed disclosed service fees, and the marginal, there will be no premium because the marginal economic profit will be zero. And then, I mean, you have sunk costs, so the business model won't exist anymore because your marginal fee will be your marginal cost.
You're too smart for me. I'm going to give you a
Price gouging.
Beautiful. It's 3 a.m. You've got to get home from the club. The taxi cab driver's the only taxi cab driver around.
Shoes in hand.
Right, right, shoes in hand. You got it. That taxi cab driver could say, how much you got? It's an opportunity for them to do that if there isn't really a regulation. And I want to point this out to you because the cost of liquidity is directly tied to the urgency of the liquidity buyer. It's going to cost you more depending on your level of urgency. And in certain services, regulators have said, hold on, let's just make sure that gouging can't take place. We've got to put in some rules here. Now, what's dangerous about this regulatory gumbo is you can screw up. I'll give you an example of a screw up. What if de Blasio said, you know what? A taxi cab can never charge more than $10 for any ride in the city. Somebody give me a prediction as to what would happen to the taxi cabs. Would we have more or less taxi cabs?
They go out of business.
All of them?
Not all of them, but based on the cost of gas and operating costs, a lot of them would go out of business.
So there'd be less taxi cabs. What's also something that would happen with the taxi cabs that are still around?
They'd get capacity constantly.
They'd be at capacity constantly, but what would they not be willing to do? Yes?
They'd only do short rides.
They'd only do short rides, you're right. So you need to get to the airport, right?
You do 5 rides.
There we go. Let's tie this together. As a taxi cab driver, as a liquidity provider, as a liquidity seller, you've put a regulation in place that caps the amount of money that I can make providing my service. Okay, I'm not an idiot. I am then going to adjust my service. I'm going to do shorter rides. And you know who that messes up? The person that needs to get to the airport. If you are reading any articles about liquidity problems in financial markets, less opportunities to trade, those problems are occurring in the institutional markets almost exclusively. Why? Because the people providing the opportunities to trade are not being compensated for airport trades. The big trades, they're not getting compensated properly, so they've stopped. So when you look at the current US equity market structure, it's lots of little trades. That's because regulations have done away with the ability to mark things up appropriately for the risk that's being taken to provide people with opportunities to trade. Does anybody have a question on that linkage? All right. So I'm going to bring this back to financial markets so you can see how it plays together. So we've agreed to all of these different areas, buyers, sellers, and their compensation model, right? So now I'm going to fold in the players in financial markets. So the buyers of opportunities to trade in financial markets are mostly asset managers, hedge funds, insurance companies. They've got cash that they've got to manage. They want to buy stocks. They want to buy bonds. They want to buy derivatives. They want opportunities to buy and sell those things, okay? So they're liquidity buyers for the most part. The liquidity sellers here are people like market makers, specialists, and broker-dealers. Their business is to sell opportunities to trade, okay? That's what they do. That's my business as a market maker. I'm making the market. I'm making it convenient for everyone who wants to trade. I'm making it possible, and they've got to compensate me for that. Now, the compensation models, when you look at any financial market, you've got to ask yourself, okay, if this person's a market maker or a specialist or a broker, how do they make money? Is it a commission? Is it an undisclosed markup? Is it a disclosed markup? These are clues for you as to whether or not the risks associated with providing liquidity are high or low. The lower the risks, the more you're going to see a commission model. The higher the risks, the more you're going to see the industry actors push for undisclosed markups. There's also some more interesting things that are out there. People pay for order flow. Because order flow, or having people engage me to trade, in certain markets, it's incredibly valuable, but it's only certain types of people. If you were providing liquidity as a market maker, whose order flow would be very valuable? Whose order flow do you think you could make the most money off of? Because they don't really know where the market is.
Retail.
What?
Retail.
Retail. Correct. Sometime in the mid to late 90s, Citadel came up with this idea where they went to Fidelity and they said, hey, listen, Fidelity. Okay, listen. Anytime one of those grandmas, grandpas, or like stock traders, you know, who have no sophistication, anytime they're going to try to do a trade through you, send the order flow to me. Fidelity says, why would I do that? Oh, because I'll pay you hundreds of millions of dollars for that.
But that's illegal, right? Is it legal?
No, payment for order flow is completely legal. As long as when you provide the execution, you're doing it at the best price. But what Citadel knows is that the people who are doing trades that are coming from Fidelity are not aware of what's really going on in the market. So oftentimes they're buying when everyone else is selling and selling when everyone else is buying. And getting first crack at their order flow is worth millions. Yes?
Is it best price or does it say most convenient?
Best price. There are big rules that have been established in equity markets that you've got to respect the best price when you print someone. It's called best execution rules. Now here's something really quirky that makes this a little bit harder to understand, but I think if you can nail it, then you'll be able to get a lot of the nuances around liquidity. There's a human tendency, and a lot of what I'm kind of talking about here, what I've weaved in here, is behavioral economics, which is really the study of the weird, which is a study of like, why do we do weird stuff, like constantly, the pattern of the weird. So here's a weird pattern, right? If you are a liquidity buyer, you constantly feel like you're paying too much for the service. This is too expensive. It's just too expensive. That's just what I feel. I could have done this without you. That's a general feeling that people have when they're buying liquidity, okay? When you're selling liquidity, you're feeling like, I'm not getting compensated enough. That's the human tendency. Because this is something that happens in almost all markets. Nobody stays just as a liquidity buyer or a liquidity seller. They actually change their roles depending on what part of the process we're in. Let me give you an example. Where is an asset manager? When are they a liquidity seller? What service are they selling? What service of convenience is an asset manager selling? Yes?
So they're managing the funds for their investors, so basically they provide them access to the market or...
But what service, like if you've got a bunch of money, you got an inheritance, and like you're gonna put your money into a bond fund or a mutual fund,
convenience to trade for those individuals
Right, they're saying, we're experts.
and the access to the information that.
Yes, we're experts, let us handle this for you. You're not an expert. Just give me the money and I'm gonna manage it for you. Do they do that for free? No. Sorry, you had a question?
Well, I was going to try and answer.
Oh, sorry. Yes, she nailed it. They're gonna.
I was going to say like to generate like returns, right? Like that's what they're saying.
No, asset managers actually don't get paid on generating returns. Hedge funds get paid on generating returns. Asset managers get paid based on what? Does anybody know? Yeah, assets under management, baby. That's it. The more assets that are under management, they charge a fixed fee just based on how many assets they have under management. And guess what? Have you guys been paying attention to like passive versus active funds? Do you know anything about what's going on here? So an actively managed fund actually has a human being making decisions and saying, I think that we should invest here, I think we should invest there. A passive fund is just saying, just replicate beta for the marketplace. If the market goes up, the fund goes up. If the market goes down, the fund goes down. Because there is a theory out there that over a long period of time, there is no difference in performance. And passive funds, because they require no human judgment, because they're literally a computer that is paying attention to what are the things that must be a part of this asset concentration in order to replicate the market holistically, they're at a deep discount in terms of the fees that you pay as an end investor to an actively managed fund. Now, in this case, the asset manager is acting as a liquidity provider, right? The service they're providing is expertise around the trading process, management of your cash or the assets that you have invested, okay? Now, when they actually try to trade those assets, they become liquidity buyers. They're looking for someone to provide that service to allow them to trade. Now, with market makers, there is a point in time in the process in which they themselves become liquidity buyers. Would anybody, this takes like actually kind of working in the markets to know this piece. But market makers, actually, there's another market that exists in almost every market. It's called an interdealer broker market. It's a market, think of it like the wholesale market. Asset managers are not allowed in that market. Culturally, they're not allowed in that market, okay? Only the market makers, only Goldman Sachs and JP Morgan and HSBC and BNP can trade in that market. And that market, what those banks are looking to do, those market makers are looking to do, they're looking to hedge themselves. They're looking to get out of risk. They're looking for the service of convenience to get out of risk. And guess what? There's a broker that provides that, the interdealer broker. If you've ever heard of company like ICAP or BGC, that's what they do. And they make billions of dollars a year. And all they're doing is they're brokering trades. So remember, so if they're brokering trades, what's their compensation model? Commission. If it was there's no way culturally they could get away with an undisclosed markup. The dealers would flip. Now, I need to know exactly what you're making down to the penny. Those conversations happen every year. So, you see in this theory, we're not just talking about how does it work here, we're talking about how does it work in all of these different areas. We're trying to string it together. Does somebody think they can break this theory? Let's talk about Uber for a quick second to see if you can really nail this theory. Is Uber a liquidity buyer or a liquidity seller? Seller. They're selling the service of convenience, right? Who are they selling the service to?
Drivers and riders.
Drivers.
Drivers.
Is it drivers and riders, or is it just drivers? You say it's both? Uber right now, it's just drivers. Want to know how I know? Uber doesn't make money yet. Uber subsidizes your ride. Uber is actually paying for your order flow. You're so valuable to Uber because Uber charges, the service that Uber's providing to the cars is, I'm going to make it more efficient for you to find rides that will pay you money. And that's a big service if you think about, without Uber and you're driving a car, you're just like kind of driving in circles. So it's actually very valuable. That service of convenience is very valuable. talk to your Uber or your Lyft or your Juno driver. Talk to them when you're in the car. And you want to know how I know I'm right with this theory? Ask them how they feel about Uber, Lyft, and Juno. They'll be bitching about the costs. They're the liquidity buyer. It's too expensive, man. I don't know. What the game plan is for Uber, and this is what I mean in like terms of like higher theory around this type of stuff, is Uber is subsidizing your rides, hoping to dominate, because if Uber gets more people on their app as opposed to everyone else, what can Uber then start to do? Take away the subsidies and raise the price that they charge to the drivers, because they've basically created a more exclusive market. They have a more valuable service because there might be 10 million people that are on the Uber app as opposed to the other apps that only have 1 million. And that's the game, yeah.
But the switching costs are so low for an Uber driver to go to Lyft or go anywhere else. That seems really dumb. If that is what they're trying to do, if they're trying to get enough market share to be like the network effect.
Totally.
You can't keep them.
Totally, that's why you're Uber Eats and all this other stuff. They're trying to pivot. Like, let's figure out other ways to apply this type of model. But you've got it correct. Like, you know, you can't lock this market up. The technology is, you don't have a patent on this technology. So that's what we've seen. I bet you when Uber first came out, if you were an early user, you were like, oh man, they've got the game on lock. Really? Lyft came around. Now Lyft is viable. I'd never heard of Juno until last week. But somebody was like, oh, you can get 30% off. Okay, so let's just talk for a quick second, because I just came up with an idea, and I'll give it to one of you, and you'll make a lot of money. What's the idea now that there are multiple ride applications out there? Yes?
One app that you do price comparison on all three.
Bang.
But it doesn't work because all of these companies are doing their own beta testing, and if we're both standing on a street corner, I'll get a different price than she does. They're already doing.
Right, so it's the problem solving around that. But like at the beginning of this, mentioned that one of the companies that I built is a company that is aggregating data, right? I'm aggregating data to give exactly that effect, right? The Expedia effect. The coordination of the available pricing information for the liquidity suppliers or for the out there, that's a big business in anything. If you can coordinate that data in a way that makes it easier for someone to find the best price, possible price. Now this would also take, and it's the same thing that I've had to deal with, it would take Uber and Lyft and Juno being complicit about sharing what with you as this aggregator app. What would they have to share?
Markup?
What?
The markup?
Not the markup.
Price.
Price, who said price? Yeah. So Uber's like, screw you, I'm not showing you my prices. Like that's the problem we would have with this idea if we were going to do it. Now, interestingly enough, and yes, go ahead.
Yes. So for Uber, I think the way out is to the pool model.
Maybe.
Because yeah, as she said, like the switching cost is very low, and the Uber now basically it's like squeezing the profit margin of the cab association. But if the cab association want to fight back, they can lower the cost, and people will switch back to the cab. But the problem is like by Uber you got the user base and also got your algorithm to like define the better rules. You can have like more pools, like the people sharing the same cab. This can be something the cab drivers they can't do.
You see how being challenged starts to push innovation, right? It starts to really push innovation. I'll give you my market structure dynamics idea for Uber. Here's the idea, right? And I know that they've already started doing something like this. You've got good drivers and you've got bad drivers. You've got people who are good drivers with nice cars and you've got people who are bad drivers with shitty cars, right?
It's very hot.
Right. So what I would do if I was Uber is I would create a system in which if you are highly rated as a driver, you get higher quality rides.
Mm-hmm. Yeah.
And so then what Uber ends up being is it differentiates itself from everyone else because, okay, you know what I'd like if I'm going to ride? I'd like kind of a nicer car and I'd like a driver that's been proven to be really, really good.
You're introducing the Rotten Tomato model into this Uber. It's
everything you look at, there is a repeating pattern around what are the things that are going to be valuable. That rating system in Uber is huge. It does a lot of things. But this is why I love this stuff. because if you believe in it, then we could sit in here for a couple of hours and figure out a kick-ass idea. Or, on the other side, if you guys were trying to get into private equity, you want to be VCs, you could look at ideas and you could figure out which ones are good and which ones like, nah man, this is not going to work. All right, so this first module is a little bit of a bear and I'm just conscious of our time. Oh my God. All right, but I've got to take you through the last piece and then we're going to do a break, okay? All right, so here we go. So I'm going to talk to you about the sort of advanced portion of market mechanics, and this is really important. When I was talking to you about liquidity, you mentioned one of these things. But basically, markets are cultural systems, remember? Every market's comprised of liquidity buyers and sellers, and liquidity is best described as a service of convenience. If you walk out of here remembering that, if you want to take a picture of that, like keep that, try to break it. If you think you can break it, call me. But like this works everywhere. Even if you think about like, just think of any market that's out there. It's going to behave according to these fundamentals. Financial market liquidity is literally the opportunity to trade, okay? But this fifth part, we just need to go over. What elements determine how markets work? What are the invisible forces that are influencing how these markets work and evolve? Here are the elements that I am presenting as being the most important forces. There are 4 of them. The first element is crowd size. What crowd size is the total number of liquidity buyers and sellers in a given market. That's one element. This is going to determine the level of market availability. Is this market only available like, an hour a day? Or is this market available all day? Here's the next one, float. Float is the total outstanding size of the market. This determines the level of product availability. The market could be open, but how much of the product is out there to trade? The float is the terminology that we use in a lot of financial markets, but it can be applied anywhere. How much float is there? And one thing you should know with derivatives have an unlimited float. Why? Because what a derivative is, it's effectively a contract. So when I was working at Goldman, if somebody said, hey, I want to buy some credit default protection from you on Sears, which actually would be a good thing to do 2 years ago, Goldman could just say, okay, I'll sell you, how much protection do you want? 100 million, 200 million? And out of thin air, they've created a contract that is now traded, okay? Thin air. You just write it up. But when we're talking about, hey, I want to buy 100 million Sears bonds for you, there's a finite amount of Sears bonds outstanding. So Goldman can't just say, oh, here you go. Here's 100 million in Sears debt. So it's very important to know, like sometimes when I'm talking to people about like market structure, they'll give me, and I'm talking about securities markets, they'll give me some example and they'll use a derivatives market and I'm like, doesn't apply. Just a different situation when you're talking about something that has an unlimited float. So standardization. Now what standardization is this thing the sameness of something? This product that we're trying to trade? And the reason why standardization is so important is because it determines the size of the liquidity seller group. For a while, my wife was really into unpasteurized milk. Has anybody ever had unpasteurized milk from a grass-fed cow? Shit, it's delicious, right? It's unbelievable, okay? And so like every Sunday night at like 10 o'clock, some guy would be delivering it. And it's expensive, right? It's a non-standard product that's out there. You know what's a standard product? A half a gallon of whole milk, which I could get at any bodega anywhere in my neighborhood, right? See, the standardization of that size and that milk fat content, it's so standardized that like every single liquidity provider has it. And this last thing, and this is something you should always think of, especially if you're thinking about getting into marketing, right, as a career, natural demand. The level of natural demand is an element. And what natural demand is, it determines the size of the liquidity buyer group. If we were stranded on a desert island, what's the first thing that we would need? Water. Water, yes. Naturally, that is the most essential thing you could eat. We could go 2-3 weeks without food. We can only go, what, like 72 hours without water? Maybe less? Okay. So advertising, like Axe body spray, for example, is trying to convince young teenage boys that spraying yourself with that Axe body spray is like something you have to do to be cool, right? That's the marketing around it. They're trying to increase the level of natural demand. They're trying to increase the size of the liquidity buyer group. That's what they're trying to do. They're trying to get more people to be interested in their thing. Now, in certain financial products that are out there, the level of natural demand is much, much higher. Anybody care to guess which financial product has the highest level of natural demand? You have to literally trade it every day if you're in financial markets. Who said treasury notes? Good, close. What?
Currencies.
Brilliant. The entire global market has to trade currencies every day. It's got the highest level of natural demand. In fact, when we're talking about currencies, it actually has the highest levels of every single one of these elements. These elements control the most powerful force in markets. To my original Star Wars fans out there, the more recent version's not so great. The most powerful force in markets, and something that you always need to pay attention to, and the tinkering around with those elements is designed to really control this. It's one thing. Transaction frequency. How frequently something trades is going to determine the evolutionary path of that market. The higher the frequency, the more that market is going to tend towards a fully electronic system. The lower the frequency, the more likely that market is going to remain a human negotiated bilateral market. I'm giving you the keys to something very important if you're thinking about having a career in finance and you're thinking about getting into sales and trading. Because if you could Google right now and you put up like the robots are coming in finance, the story is that human beings are going to be decimated from financial markets and it's just going to be robots in those markets, right? That's the story. That's the story they're telling you. And I'm telling you, that's not really what's going on. That's not what's going on. In the areas of financial markets where there's a high degree of transaction frequency, absolutely. If you told me, hey, I'm thinking of being a stockbroker, I'd be like, good luck. Because stock brokering is gone because the elements around stock trading have grown to the point where the transaction frequency, people are looking for discount brokers like TD Ameritrade and Fidelity and things like that. So human beings, not anymore. In fact, we see this today, like especially if you've like kind of grown up around New York City. Do you notice that all the toll booths are going away? Like gone. Triborough Bridge toll booth gone. They're still taking the tolls, but that process job has been given to a computer. Not all jobs work that way. Where there is less frequency, especially in financial markets, there's a requirement for more human judgment to deal with the complexity of the trading process. So if you do want to get into sales and trading, then you want to go towards something esoteric. You want to sell exotic derivatives, structured product, stuff where, hey, this thing only trades like 2 or 3 times a day. And when it does trade, trades in massive size. Computers can't take that over. We have not reached, who here believes in singularity? Anyone in here? A little bit? Who believes in, does everybody know what singularity is? It's like kind of Terminator stuff, but it's like human computers will become conscious, Matrix, and then start fighting human beings. Well, this idea that computers could actually have the ability to have consciousness and human judgment, it's kind of, I don't necessarily believe it. But you know what will convince me that that is possible? When I see traffic cops disappear completely. If you think about traffic lights, these are automated systems that normally, they're just run off of some sort of computer algorithm, right? But in certain areas of New York City and on certain days in New York City, probably on Wednesday if you went to the Halloween parade, you will see human traffic cops managing the flow of traffic. Why is that? Because they're dealing with an abnormal situation, high volume traffic that requires human judgment to optimally be resolved. Because a computer doesn't have the judgment like, stop everyone, let this little old lady walk across the street. So when you are thinking about ideas, where's this market going? Or hey, I've got this product idea, maybe we should put it online. You need to be thinking about these elements, this crowd size. How big is the market in terms of the number of people out there? That's going to determine, like, do we need this thing to be open 24 hours or can it only be open for a little bit? Who here, is Gilt still popular with people? Anybody use Gilt? G-I-L-T? Gilt is a high-end clothing retailer that does a flash sale at 12 o'clock every day. The appetite for high-end brands is not so big that you could have Gilt trading all day long. So it's just, hey, just for that hour. And there's also some other mechanics that they're playing on there, like your sense of urgency that, hey, I really like that brand, and they could run out of the things to sell at a deep discount, so you're like there at 12:01. Float, obviously, how much is out there? Standardization, and then natural demand. Like any market you're look at it through the lens of those elements, and you're going to be able to come up with a pretty good idea, where's this thing going? And like, I call this theory wedding dress theory. Because if you think about a product that has the lowest level of these elements, it is a wedding dress. So somebody comes to you and they say, I've got this great idea. We're going to have a continuously trading electronic market in which people can buy and sell wedding dresses. You're going to be like, not a good idea, right? That's not what people want. It trades so infrequently because the crowd size, the flow, like literally, there's only that one wedding dress that's just for me, right? Standardization, there's nothing standard about a wedding dress. And natural demand, it's like, in some cases, people have been thinking about their wedding dress for like a long time. And so the demand is already built up. And what do people want from this? They want a human being to work with. And some of the best ideas are ones in which maybe just for wedding dresses, what you could do is build an app that shows everyone the different styles that are out there. Then you can come into the store and we'll figure out the right one for you. See, not every single thing that you build has to be transactional in nature. And in fact, you know what you get just building that app? What's the most valuable thing you get from building that type of app?
Data.
That's right. Same play over and over again. You guys are, most of you are way too young to remember this, but when the internet really first started, everybody was super excited about selling and buying things through it. And then Google stepped in and just said, oh, no, just search for stuff. Sure, why not, man? Nobody understood that what Google was actually doing was the most valuable thing that was out there in the internet, which is understanding the behavioral data for what people are interacting with. And it is literally the core of the internet now. All right, this is the end of module 1, and geez, I don't know where we are in time, and sorry, this gets kind of deep. I think we're ending at 4:30.
Or 5:30.
4:30 or 5:30. All right, so first of all, has this been helpful, or is there still stuff that you guys are like, I'm not so clear? So I can always give you the source material for a lot of this. A lot of it is really dense papers written 50 or 60 years ago. The other things that we can talk about, and it depends on the level of interest, who here feels like they know how an electronic order book actually works? Because if you want to understand how cryptocurrency trading works, you have to understand how an electronic order book works. By a show of hands, who would like to know how an electronic order book works? Right? Okay, so let's do a 5-minute break, and then when you come back, I'm going to show you how an electronic order book works. All right? All right, good. Sorry. Let's go. We are, I'm telling you right now, we're skipping a few modules so that I can get you to this piece. And, okay, come on, here we go. All right, this is super, super important. The reason why this is so super important is because I'm going to walk you through the mechanics of the most popular electronic trading protocol. This is a protocol that, like, when most people think about electronic trading in financial markets, they're describing this protocol, but they don't exactly know how it works. And not knowing how it works puts you at a major disadvantage. So you're gonna walk out of here, you're gonna be like, oh, I know how an electronic order book works, and I'm much smarter than the people that I'm walking next to that didn't attend this seminar. So the mechanics of an order book, okay? In order for you to understand this, what we're talking about is an electronic order book. This is kind of what it looks like. Does this sort of like, when you think of like, hey, a financial market, it kind of looks like something like this a little bit, like it's laid out a certain way. This is a pretty hideous looking order book, but this is what we see when there are like movies about Wall Street and like stuff like that. We're seeing all these numbers moving around. I'm going to explain to you what this actually is, right? So order books are one of the most misunderstood concepts in financial markets. And knowing the history and the mechanics of an order book is essential to understanding electronic trading in financial markets. I would tell you it's essential to understanding just electronic trading in any market. So here are the misconceptions. And anytime I'm like talking with people or when I hear people talk or what they're writing about, I can tell whether they know what they're talking about. All right, a couple of clues. Here's one clue. Some people will call an electronic order book an exchange. They think these are interchangeable terms. They are not. An exchange, I'll explain what the difference is here. The order is different. An order book is ideal for all markets. There are literally people who just believe, make an order book happen and all of our fears will go away around how this market will trade. Just make it turn into an order book. I hear this all the time, okay? And the last one is somebody will say, they'll talk about an order book and they'll say, we need to build a central limit order book here. This to me, to a market structure geek like me, this is like fingers on a chalkboard, okay? The reason why this is like fingers on a chalkboard is because this stands for central limit order book, which means the order book of order books. And so when somebody says that, I give them like a snarky comment. I'll say like, great, how many order books are out there for us to centralize? What do you mean? They're talking about a limit order book. It's just one. So when we're talking about an exchange is just a collection of protocols. It doesn't necessarily have to be an electronic order book. In fact, IEX is an exchange that's introducing new protocols. I don't know if you guys are familiar with this exchange, but from the Flash Boys, they have a different type of protocol system. They're an exchange. An exchange is just a collection of rules. What those protocols are, overwhelmingly for most exchanges, it's an electronic order book, but these are not interchangeable. Order books have a lot of imperfections. In fact, at the times when I'm able to talk to regulators and who are concerned about flash crashes, I'm like, want to know what the common theme is with all these flash crashes? The way that these order books are set up. And then, I already gave you my rant. It's really a lob, not a clob. All right, so electronic order books are the dominant protocol for most modernized markets and therefore viewed as being the goal of financial market evolution. The nirvana, if you will, the Xanadu, the heaven, it's just not true. And so I want to talk to you about the world before order books. And if you understand the word before electronic order books, then you're already cooking with gas. This is the world before electronic order books. This is a floor of the New York Stock Exchange in the 50s. This looks like chaos, right? Chaos. Well, this is organized confusion. Very well organized confusion. This is, for people who are working in the market, this is just like walking in the supermarket for you. I know exactly what's going on when I walk on the floor here. I know what that guy does. I know what this person's doing. I know what that means. How does an exchange membership work? So everybody on this floor of the exchange is either a member or they're leveraging an existing member's membership. You can't trade on the exchange unless you're a member. It's a closed club. In the same way I described that closed club in clearing, the way that a lot of people make money is they have a membership in exchange, and if you want access to that exchange, like the New York Stock Exchange, you must trade through that member and they take a piece. They represent your business. Only members are allowed to transact. Who are the exchange members? They're brokers, people that are literally handling orders, right? Same way like a real estate broker. Hey, you want to buy, you want to sell, I'm going to get that done for you very quickly. They could be floor traders. These are kind of prop folks. I inherited a bunch of money. I think I can beat the market, so I'm just going to trade directly for myself. Or they could be specialists. What's so special about the specialist? The specialist is like the dungeon master of the floor of this exchange, right? They control the action. So when you're looking here, this guy, he looks like a broker to me. This guy, he's wearing a specialist jacket. I can recognize who's in here and what they're doing. Now, what role does each member play? If you're a client, right, like you, and you wanted to trade a stock, you would call your broker, okay? You're a non-member. You call your broker that's a member. And your broker doesn't have to be on the floor. In fact, they aren't. Your stockbroker, like if we're going old school, it's like, hey, I'm a stockbroker. I can help you get access to the market. That literally was the job. Now you could open up an account on E-Trade and now you can get access to the market. Because this has been computerized away pretty much. But what used to happen is you call your broker would be like, hey, no problem. Then they would call one of the floor brokers. Now, depending on what you wanted to trade, they're going to call a certain type of floor broker. If you want to trade something that's just like plain vanilla, no problem, like almost any floor broker could do it. But there were some floor brokers who are like, yeah, if you really want to trade that stock that hardly trades or tech stocks or any of those things, you call me because I'm connected. Because what's going on that floor is one big social engagement. And he's saying or she's saying, I'm connected because the dungeon master runs the game. The specialist, what a specialist does is they are responsible for maintaining an orderly market in a given stock. And because of that, they're given special powers. And what their special powers are is one, they can broker trades. So, hey, I find a buyer and I find a seller, I'm gonna match you guys up. Or they can deal. What a deal is you wanna sell, I'll be the other side. I'll buy, okay? So I'll be the person you do the trade with. Now, for the most part, the other thing that they get, their little special thing, right, is you wanna buy? 100, right? 100 shares, okay? What price? Give me the price. $10, okay, 100 at 10, and what time is it? Okay, fine. You wanna sell? How much do you wanna sell? You wanna sell 100? What price?
12.
Okay, great, 100 at 12. So 100 is 12, okay. All right, great. That's what those pieces of papers are about. A book. I'm the specialist. I'm just writing down your orders in a book. And I'm organizing them in my book. It's all being managed by human beings. That's why that floor broker is like, yeah, the specialist at that post, that's my boy. So if you ever want to trade it, you call me. Because that specialist is he's gonna tell me what's on the book, right? He's gonna help me out. Let me tell you something that we've lost a little bit here, and you should always think about this. People think that to get rid of corruption in a market, what you must do is eliminate the human element from a market. In fact, there's a brilliant paper by Fisher Black, the person who basically invented the Black-Scholes model, right, for options, risk management. It's called Towards an Automated Exchange, and it's a beautiful paper because he's writing about the future to come, and he's right about so much of it. He's writing about what's going to happen when computers can actually take over stock trading. And inherent in what he is thinking about is, you know what's going to happen? Corruption, done. But there's something that's lost when you put a computer in charge of a marketplace? First of all, does corruption stop when you put computers in charge? Michael Lewis made millions of dollars writing a book around how corruption's worse than ever with all computers in charge in the stock market, in terms of that Flash Boys book. So no, corruption doesn't go away. Corruption just becomes computerized. Algorithms are now corrupt, at least viewed as being corrupt. But here's something really important, and this has to do with behavioral economics, this has to do with sociology, right? Order was maintained in the pits because of the social proximity that everybody had to each other. Let me be clear about that. Every day, I'm the specialist for this stock. Every day, if you want to trade this stock, you've got to talk to me. Hey, last week, you were kind of a jerk to me. Maybe I don't write down your order. Hey, last week, remember you took me out for drinks afterwards? Your order goes first. See, what happens ultimately, though, is people are actually more respectful of the rules when they have to look somebody in the eyes every day in order to trade. Proximity, the social policing, is what kept that thing that looks like chaos, for the most part, pretty orderly. Yes?
How many specialists are there? Do they have competition between them?
Great question. On a given exchange, there's only one specialist per stock, but there can be multiple exchanges. So you could have a stock, you could have IBM trading at the New York Stock Exchange, trading at the Amex, trading at the Philly, trading at the Pacific Exchange. In fact, that's the way the market did work. And before computers really got involved, what do you think would happen if you had all of these different exchanges with uncoordinated specialists? What would happen?
Prices.
What?
Different prices for the stock.
Bingo. Like this massive arbitrage out there where it's like, I can buy this stock at $10 in the Philadelphia, but it's being sold at $9 in the New York. Believe it or not, that's what's happening right now in cryptocurrencies. With Bitcoin, if you're looking on different exchanges, the bids and offers are different. Isn't that amazing? This like advanced, progressive product idea, this advanced progressive market, they have not coordinated their pricing across all exchanges. That had to happen. That happened in the listed market in 1975 and the unlisted market in 1971, where the pricing had to be coordinated, had to be centralized. It's actually a really key part to how a market modernizes. Anyway, so in here, right, the floor broker, they can do a trade with another floor broker, right? They could say, hey, you guys could talk to each other directly. It's fine, you don't even have to talk to me. You could start negotiating together. You said you wanted to sell for 12. You said you wanted to buy for 10. You guys could start a meet in the middle at 11. But you know what you can't do? You can't leave me out of the conversation. You have to let me know what happens. As a specialist, I'm the dungeon master. I control everything. The principle of my job is to keep the market orderly, make sure that there's enough liquidity in the market, opportunities to trade, and I do that in two ways. As I mentioned, I'm either organizing the market and matching people up, hey, you should talk to him, or I'm the market, in which I am the other side of the trade. Now, what's so special about the specialist? Okay, on an exchange, each stock has a single specialist. The specialist is responsible for keeping an orderly market. Every trade the stock must go through the specialist. Just repeating myself. The specialist can either act as principal, that's like, hey, I'm the other side of the trade, or to a trade, or agent, that's brokering. Specialist maintains the book. Here's my book of all unexecuted orders. This is the world before electronic order books. So every exchange pretty much worked. Remember, the exchange itself is just a rule set. This is how we're going to get to a trade. There's going to be a specialist here, and then everyone has to be a member to trade, and some of you can be floor brokers. That's all it is, like coming up with the rules of your clubhouse. Now, something changed. The origins of electronic order book. In 1977, the Toronto Stock Exchange introduced the first fully electronic order book. CATS. Computer-assisted trading system. What was it assisting the specialist with? As a specialist, you know how I make money? I make money either because I buy low and sell high, okay? And by the way, the fact that I know what everybody wants to do in the stock kind of gives me a huge edge to do that. That's why there are order handling rules, like there was stuff I wasn't allowed to do, but I kind of did it anyway. The other way that I make money is by brokering trades. When I match you two guys up, you've got to put the trade through me, I take my piece. But you know what's annoying? How many shares do you want to sell? 100? How many trades do you want to sell? 100? Buy 100? That's annoying, because I can't make a lot of money on that. I get paid based on the amount of shares that you're trying to trade. You know who I'm interested in dealing with? You want to sell 10,000 shares, right? Yeah. You want to sell 30,000 shares, right? Or buy 30,000 shares, great. I want to talk to you. You, go away. So this was the go away system. Putting your little order in the electronic system that we created. Cats. You put your order into cats. The adults are going to trade over here. This is the origin of the protocol that dominates all markets today. Never forget that this is a cleanup protocol for small orders. I'm saying this to you because it was never intended to handle large orders. Yet that is what people have been trying to do. They've been trying to take this protocol and use it for trading really large size, and it is completely suboptimal for that. So that question I asked you guys before, like, why would, yes?
Does the floor traders can trade the same stocks as specialists or not? With a limit?
The floor trader can trade whatever they want, except in the old days, if a floor trader was going to trade something, they couldn't trade without the specialist being involved in some way, shape, or form. It's just like, you've got to tell me everything.
They had to submit the trades to the specialist.
Yes. Yes. Okay. So, the mechanics of an order book, like that ugly thing I showed you in the beginning, this little thing right here, you've got to understand something about what is an order. So, how does an order book facilitate trading? It organizes limit orders. Does anybody here know what a limit order is? Yes, what's a limit order?
If I want to put in a order, but I want to limit the price that I'm buying it for.
Brilliant. That's a limit order. A limit order is an order with a defined size and price. So, did you give me a limit order? What was your limit order? Sell 100 shares at what? 12, right? It's a limit order. Did you give me a limit order? This order book is just organizing the limit orders. Is it possible that you could sell on your limit order, that you could sell it for anything less than $12? No, it's not possible. Is it possible that you could pay more than $10? No, it's not possible. Those are the rules. This book is supposed to be organizing these orders, and this book is determining who put their orders in first and who's on top. Yeah.
Were they putting in stop orders at that time as well?
A stop order is when you've basically given an order. Like, okay, here's one. If you've given me an order to sell at 12, right? But the market starts cratering, you could give me a limit order that says sell at 12 and stop me out at 9. Now, I traded both the unlisted and the listed markets when the semi-old days, and you know what specialists would do? They'd bring the market down to trigger your stop and then bring it back up. So the market right now is, he's got the best bid at 10, she's got the best order at 12 with a stop at 9. I clear his order, bring the market down to 9, buy her stock at 9, and then bring the market back up to 10. And I'm the one that bought it at 9. Yes?
Follow this. So the specialists say exchange employee. Is it correct?
Well, no. You have to buy a specialist seat. Like, the exchange is just setting up, think of the exchange as like the NFL, right? Or like any sort of sports league. And so if I'm going to be the Dallas Cowboys or the New York Knicks or something like that, like I've got to pay into the league, right? And then now I'm the special person on the floor.
But the specialist is third party. can meet the price. So in the old days, I can like set up a company full of I buy all the seats in the exchange. I have like, all the special seats to kind of like, because they can be the broker and the dealer.
Yes. So the specialist seats were very valuable, but there were only a finite number of specialist seats on an exchange. The same way that a taxi medallion was very valuable because there were a finite number of taxi medallions. Taxi medallions were almost selling, I think the top tick price was like $1.2 million to have a taxi medallion in New York City, right? Yeah. But similar to the taxi medallions, as the market started electronifying, the cost of the specialist seat went down dramatically. Okay, so an order book is supposed to maintain a rule system. This rule system is something that you've probably heard. I'm going to explain it in intimate detail. Price, time, priority. What this rule system is saying is that, hey, listen, sort of cultural convention has been, because you were the first person with the bid that had, you've got the best bid of $10, limit order, and you were first, okay? So now if somebody else comes in and says, I'd like to buy the stock for $10 as well, they're behind you in the book. Who wants to buy the stock for $10 as well? Help me out, somebody. Who wants to buy the stock for $10 as well? Okay, $10, here you go. How much do you want to buy for $10?
100.
100, another 100 order for $10. He's behind in the book. And where you are in this book is really, really important. And this is why. To be listed first, you have to have the best price, then you have to show up first, and then they had this thing, size is really the rule breaker, but actually computers have now gotten so fast that, like, basically there's no such thing as a tie. There's no such thing as two orders coming in at the same time, because now there's sub-second differentials between when one order came in or another. So anyway, the book facilitates trading of market orders. You're my market structure expert. You told me what a limit order is. Who knows what a market order is? Anybody want to take a guess? Do you know what a market order is?
The market price.
Market price. What's the market price?
What the split between a buy and a sell price?
No, close. What's a market price?
It's the market price is the lowest price you can execute your order right now. I mean, the lowest offer and the highest bid, but you need to clear.
Okay, so I'm going to show you guys something, all right? What's the best bid in the market on this fictitious stock that I'm the specialist?
$10.
$10. What's the best offer? What's the market in this stock? What?
10.
Is it 10 or 12?
12, because there's no deal.
No, the market in this stock is $10 at $12. When you're hearing people speak market jargon, you say, what's the market? And they say, oh, it's 25 and a quarter, 25 and a half. 25 and a quarter, 25 and a half. What they just told you, the first thing they said is the bid. The best bid is 25 and a quarter. The best offer is 25 and a half. You ask me what the market is in the stock, it's $10 at 12. That's the market. So when you're saying a market order is an order with a defined size but no defined price, it's letting the market define the price. What's the market in this case? Who's defining the market? The
bidder and the seller.
But the people who have given, what orders did you guys give? Did you give me market orders or limit orders?
Limits.
The limit orders define the market. When I'm quoting you what the market is in this stock, I'm quoting you what the best available bid is that's a limit order. What's the best available offer that's a limit order. It's really important. That's how all of the pricing is derived in the equity market. That's how you know, if you look on your phone and you want to know, like, where's Microsoft trading right now? They're literally letting you know, if I wanted to sell Microsoft, I would have to hit the 25 and a quarter bid. Okay? So when I'm giving this market order up, right, to a specialist, because, say, you're giving me a market order. You come to me and a specialist like, hey, Chris, giving you an order. You want to buy or sell?
Buy.
You want to buy?
Yeah.
You give me a market order?
12. Yeah.
No.
No.
You're giving me a market order. You want to buy? How much size do you want to buy?
50.
50?
Yeah.
Here's what happens. Where's he going to buy 50? Where's the market for 50 if he's buying?
It's going to move through the limit book.
Well, hold on. Where's the market for 50 if he's going to buy? Where's he getting executed? Where's the market defined where the best offer is for 50? 12. Great. You're gonna get 50 at 12. What happens to her order of I'm selling 100 at 12?
Half gets filled.
Partial fill.
Half of it does get filled, that's right. So now she still has her position in line, but now she sold 50 to you, okay? Now this was all maintained manually. Can you see what a pain in the behind this would be? Especially when the market's super volatile, especially if all of you are yelling at me and I'm the specialist. Sorry, you had a question?
Well, I'm just thinking it goes back to why someone chooses an OTC market. Because, you know, if he's at 1,000 and she's got 100 on there, and then it's progressively moving up the order book.
Okay, stop right there. Because you said something that's absolutely correct, but I think for a lot of people they wouldn't understand what you mean in terms of moving up the order book. So I'm going to show you what he means. Sorry, how do I... I don't know.
Are you trying to get to the internet?
No, I'm trying to show my screen that's... Sorry, guys. No, it has my screen, but for some reason it's... I want to show this web page on the screen. I want to show this. So, how do I... It's not showing your screen now, but let's just see. Yeah, they're in. I ended the slideshow, so maybe I have to kill the deck. Okay, I killed the deck. Oh, this sucks. Is it like
Yeah, let's try that just one more time. That should be.
Duplicate. Okay, let's do that. I think that might have fixed it. There we go. Wonderful. Great. All right. Sorry, this doesn't work without this visual aid. This does not work without this visual aid. You will not understand this unless you're seeing it. So I made this. I had somebody code this for me. This is all bullshit, but it will get you to understand exactly what's working, what's happening right here. You see these numbers moving around? First of all, what's the market on Microsoft right now? Somebody quote it to me.
23.42 at 43.
Come on, be like a professional. 23, 40, 43. You normally don't say the 23 again. Okay? You guys are going to sound like pros. Okay.
540.
Okay, thank you very much. That's where we're going, right? All right, awesome. So, why are the prices moving around? What's happening here?
More sellers than...
Wait, who said that?
They're being filled.
They're being filled. What's being filled?
The orders.
Which orders?
Limit orders.
The limit orders and the market orders. The market orders are invisible. You never see them hit the book. Like they don't show up as a line item. They just run into the book and they start eating their way through the limit orders. That's why you're seeing this thing move around. Because what the computers are doing is they're managing these market orders that are coming in. Now I'm going to talk to you about the mechanics of this, right? So what's cool about a limit order? What do you like about a limit order?
You get your price.
You get your price, right? Remember I told you, you're not going to buy for anything higher than 10, you're not going to sell for anything lower than 12. Great, that's cool. What's not so cool about a limit order?
Probability of failure.
What?
It can't get traded if the price doesn't hit that. Like if it doesn't hit $10, you won't be able to buy it.
Perfect answer. You might not trade. What's not cool about a market order? What? Wait, who's saying that?
It's not 100% sure what price you're gonna settle at.
Right, you've given up control of the price. What's really cool about a market order though?
Your orders will get through.
Absolutely will get filled. I'm going to give you this analogy that many of you in this room have dealt with. I know I dealt with it a lot, right? You're going to go out to some New York nightclub with your friends, right? Okay? Now, there's a $20 or $25 cover. So you stand online. You're a limit order. You say, I'm not going to pay more than $25 to get into this club. And you know what? You may not get in. You may stand outside all night. How do you get inside the club, like, guaranteed? It's like, what?
Bottle service.
Bottle service, that's what you do. You go up, you say, I'll let you determine how many bottles do I have to buy to get in here with my friends. Okay? Remember what I was telling you before. There is a direct relationship between how much something is going to cost, how much is the liquidity going to cost, and your urgency as a liquidity buyer. I have to get into the club. It's my friend's 21st birthday. I can't miss it, right? So how many bottles do I have to buy, right? You're going to pay. But if you really could take it or leave it, I'll just go somewhere else. I'm not going to pay bottles. So let me ask you, I want to see how well we've grasped the earlier portion of this course. In this arrangement, who is a liquidity buyer and who is a liquidity seller? Map them for me. The limit order provider, are they a liquidity buyer or are they a liquidity seller in this relationship?
Seller.
Seller, because what are they selling?
An order.
No, they're selling the opportunity.
Yeah.
Opportunity to trade. So who's a liquidity buyer?
Market order.
The market order, they're paying according to what the liquidity seller determines with their price. Now somebody in the mid-90s got really smart about this, okay? And they took this idea and they said, you know what? We're going to crack the New York Stock Exchange. We're going to crack, actually the first market they went after, we're going to crack NASDAQ. It was a company called Island, started by a bunch of day traders, okay? Now, how they cracked this was with a concept called maker-taker. Remember, if we're talking about the two basic foundations of a market, there's a liquidity buyer and there's a liquidity seller, and you want there to be more trading opportunities on your exchange, your new exchange, what's something that you could do to make your exchange an environment that provides more opportunities to trade than the NASDAQ system itself? What could you do?
Market.
You could lower commissions, or you could do what? Let's turn it up. What else could we do?
Market order.
No, not market order, not lower prices. Turn it up, come on, get everybody to this thing. How do we do it?
Aggregate across exchange.
No, come on.
Guarantee, absorb liquidity risk.
No, the liquidity sellers out there, how do we get more liquidity sellers to sell their liquidity on our platform?
Eliminate the.
Or, what's better than eliminating the commission?
Paying them.
Pay me. If the commission is 10 cents to trade, what they said was, if you're taking liquidity and you're putting a market order through the system, you're paying 10 cents. If you're making markets on the system, when a trade happens, I'll pay you 5 cents. Oh, my God. Figuring out the incentive package to get more people to provide liquidity on this order book, that changed fundamentally the trajectory of electronic trading in US equities. Full stop. Now there were more incentives. So people were like, what? I can make money just making prices on this thing all day, and when a trade happens, I get a little bit more money back to me? I'm in, because NASDAQ wasn't doing that for me. This is just like Uber, where NASDAQ's thinking, hey, I'm Uber, I'm the only place you can come to if you really want to trade these stocks electronically. Then Lyft and Juno and these other places started popping up, and you know what they did? They changed the model, and they said, I'm going to change the economics around the incentives here. And that's how they started to crack NASDAQ And you know what they did? How well they cracked it? In 3 years, they beat the biggest platform that had been in NASDAQ, trading NASDAQ stocks before, something called Instinet. Instinet had to buy them for like $200 million. This is in 1990s money, so that was a lot of money. Archipelago did the exact same thing to the NYSE exchange. They changed the incentive model. So if you're looking about building something that's competitive, you're trying to build a marketplace, differentiate your incentive model for the liquidity providers that you need to be on that marketplace, and I guarantee you, you will rapidly accelerate your ability to disrupt the incumbent. All right, so another thing I just want to show you quickly on this book. This book's moving around because you think that market orders are being executed, right? Not necessarily. This book might be moving around because people are playing games on the book. They're canceling their orders. So check it out. If I really wanted to buy this stock, you know what I would do? I'd put a bunch of sell orders in here. In fact, here's one. I put in a sell order for 100,000 shares. Why am I doing that if I really want to buy? Exactly, because I'm expressing supply and demand to everyone in the marketplace. But if I put my order back far enough, some of y'all will get spooked. Some of y'all won't. You'll be like, oh, he's just playing games out here. So when you hear the term spoofing, that's what's happening here. People are screwing around with the book, trying to make it look like there's momentum up or down, so that people responding to the visual here might make a mistake. Now, here's something mechanically, and it was mentioned by my friend in the back, and this is something that, the reason why I'm like adamant about this mistake we've made around electronic order books. What if I wanted to buy, or what if I wanted to sell 50,000 shares of Microsoft? What would happen if I sold it as a market order on this book? What would happen? Where would I sell it? Would I sell it at 23.42? Would that clear my 50,000 share order?
It would just go down the list.
That's right. It would start to, it's like acid, right? It would start to eat into the book. And if I made this book long enough, probably where I trade 50,000 shares, my average price might be something like 22 bucks. A $0.35 away from what the prevailing market price was at the time that I was doing the trade. This is something called an implementation cost or an implementation shortfall, which is, this is where the market is, right? But if I'm trying to buy or sell a large amount of this thing, I'm going to move it one way or another. Supply and demand, straight up classic economics. Now, what happened if I put a limit order in here, like a real one? If I put a limit order here and it was real, I wasn't like this spoof order that I'm showing you. A real limit order for 50,000 shares. What would happen then? To buy 50,000 shares, let's say. What would happen? Anybody have a guess?
It takes days to get filled.
Might not take, well, somebody just put in a bid for 50,000 shares. I just told everyone that there's this demand out in the marketplace. What would people start doing to the offers?
Raising their offers.
Raising the price or lifting them. I'm going to start buying. There's a 50,000 share order in here. So I'm just going to start lifting them. So when you're trying to do really, really big trades, the prevailing market on Microsoft right now is what? Give it to me, somebody. What's the market on Microsoft?
23.36.
Okay, so you know what the best trade would be? If I want to buy 50,000 shares of Microsoft, and one of you out here wants to sell 50,000 shares of Microsoft, and what we could do is we could meet in something called a dark pool. What a dark pool is, it's an electronic trading system in which I don't see that you're trying to sell 50,000 shares of Microsoft. I just put my order in there that I'm trying to buy 50,000 shares of Microsoft. And if you happen to be there already, then we execute a trade. And do you know where we execute the trade? What would be the fair place to execute that trade? Who said it? Mid?
Price.
Mid price of where?
Of your
Bid and offer.
Determined by who? Exactly. You now know the mechanics of a dark pool. That's how dark pools work. Based off of the prices that are being aggregated from all of the order books, all of the limit order books, you have in the marketplace a prevailing best bid, best offer. That prevailing best bid, best offer sets the mid price where these big, huge block trades can occur. And you know what's awesome about being able to trade at mid when I want to buy 50,000 shares of Microsoft? My implementation costs are at 0 at that point in time. In fact, they're better than if I just started lifting the offer side. And you know the person who sold me their 50,000 shares, they're psyched too. Because where they're able to trade those 50,000 shares is better than where the bid was on the book.
But where are the dark pools? Are they inside the order book?
No, dark pools are other trading protocols. There are other platforms that are out there.
And they are not surveilled by SEC or...
They absolutely are. In fact, there have been a lot of famous lawsuits against dark pools because, and I wish we had more time to go over this because it's actually really interesting. But basically, where this market has gone now is people are designing algorithms to understand what you're trying to do. If you're a big asset manager, they're designing algorithms. So they'll put their orders in dark pools to figure out whether you actually have a really big order to trade. And so what dark pools are saying is they're saying to people, this is an exclusive club. We don't allow these other people in the dark pool. Where they've gotten in trouble is they lied. They did allow those other people in the dark pool. So they misrepresented who's allowed in the dark pool. Yes?
And for, a simple way, the dark pool has an allocation for like, if you want to buy the Microsoft, like 50,000, but you can also like put a 100 offer at the middle, the lowest offer, then you can manipulate it.
So let me get this straight. You're talking about manipulating the order book so that you can get a good price in the dark pool?
Yeah.
Happens all the time. That's why people are like kind of upset with this model. They're like,
Yeah.
how are you letting the pricing that's for like 1,000 shares determine where mid-market is for 200,000?
Yeah.
But it's the only thing we got.
But why not volume adjusted price?
A volume adjusted price? Well, what you're talking about, how would the volume adjusted price or VWAP, volume weighted average price?
And and VWAP at the timestamps they traded up because VWAP it's hard to manipulate, right?
Well, VWAP actually, and we actually go through VWAP in this, but we don't have the time. But VWAP is just a measure of how effective your algorithm is that you've designed. And I feel like I have to show you guys this. Well, first of all, are you guys clear on how an order book works now? Now's the time to ask your questions on this. You want to know how cryptocurrencies trade? This is how they trade. There you are. You're an expert on electronic trading in cryptocurrencies. This is the exact model that they have in cryptocurrencies. An electronic order book. That's what they do. Now, there are a bunch of, you're talking about Gemini, you're talking about Mt. Gox, you're talking about Coinbase. These are all exchanges that are out there. This is how the trading happens for Bitcoin. Yes?
So earlier you mentioned there is price arbitrage among different exchanges. Then why don't people all register across all exchanges and then just try to take advantage of that?
It's a trading idea that has a finite amount of time in which you could actually make money doing that, but you could absolutely do that. Yes, right now you can do that. So, you want to make some money? What I love about this is as new things come into a market, they follow a pattern. If you know market structure dynamics, if you have a real strength with the science, then that idea, you'd be 18 months ahead of the game with that idea. In fact, somebody who's a part of my company, he started his own company, and what he's done is he is now aggregating all of the prices across all of the exchanges because it's like, this is a no-brainer. This has to happen. It's inevitable in order for this market to evolve. We can't have a market where you've got different exchanges at different prices. It's like, because I'm sure you've tried it, right? Like, the travel industry has almost perfect pricing. If you go to Kayak, the price is going to be the same if you go to Expedia. It's not different. So eventually you get to that. But I want to explain something to you really quickly because now that you know how an order book works, I can explain to you how just basically the overall mechanics around advanced electronic trading, which I can explain it through a story that's actually quite entertaining, but this is really what's happening in the world, right? So when we're looking at advanced electronic trading, like we're talking about algos and high frequency trading and all this stuff, right? So what you should know is that the beginning of advanced electronic trading, it starts with something called buy-side algorithms, right? And what's happening is what the buy side's trying to do, what an asset manager's trying to do, they're trying to trade on an order book, but they don't want everybody to know how much they're trying to trade. Because these imbalances in supply and demand create profit opportunities for what people think are predators out there, right? So these algos break down a large order and strategically route them to hide size. There are 40 different liquidity pools out there that you can trade electronically in equities. Some of them are exchanges, some of them are dark pools, right? But there are 40 different places. So like basically figuring out what's the best way for me to get this 50,000 share order done is a routing system controlled by an algorithm, okay? Now you measure how well this algorithm is performing by looking at TWAP, which is basically time-weighted average price. So over the course of the day, what was the average price where this stock traded? Well, where did we buy it? Now the basis between those two things is going to tell you, is this algorithm working? But a better measurement is volume-weighted average price. Hey, I wanted to buy 50,000 shares of this. If I look at the volume-weighted average price, where was 50,000 shares in aggregate? What was the average price for 50,000 shares if you were adding all these things up together? Where did we buy them? Okay? Now, these are all just tricks to mask supply and demand. By the way, this is as old as time. One of the most famous examples of this strategy is a story you probably don't know, but this is like algo trading 101 in terms of the mechanics. In the 50s, Walt Disney Land was actually not doing very well. So Walt Disney was like, yeah, we need to build another park. Let's do Disney World, okay? He was looking for a place to create a larger version of Disneyland. Has anybody ever been to either one of these things? Nobody goes to Disney anymore? All right, fine. Okay, he settled on a large stretch of land in Florida swampland because the land was cheap. It was only $180 an acre. Okay, he needed roads, and from the helicopter that he was looking at, this place that he's looking at was like the intersection between these two highways that they were building. Okay, so there's only one problem. What's the problem here? This is like a classic, like, anybody here like Westerns? Yeah, what's the problem?
People know that Disney's buying the land and they're gonna start charging
Right.
more for the acre.
It's a classic plot in a Western movie, right? The farmer wants to keep his farm, but the railroad's coming through. Okay? So what did he do? Algo trading without algos. If Walt just like strolled up in a white Rolls Royce and knocked on everybody's door and was like, I'm going to be building Disney World here, sell me your farm, what do we know is going to happen to the average price? It's going to go way up. Because what is he doing? He's expressing in the order book, I want to buy a whole bunch of this. He's expressing the demand. So instead, what he did to avoid this problem, he took several strategic steps to mask his intentions. Okay? One of those steps was he created multiple shell companies to buy the land. Chopped up his order. He in fact created like 26 different shell companies. Please tell me which one of these shell companies is actually a real name. Small World? McDuck? All of them? No, that's a very business school answer. No. Empty lot real estate. Walt had a sense of humor, apparently. He also hired former CIA agents to run a disinformation campaign in the town on some spy versus spy stuff. This is so nobody would like put two and two together. sometimes these algorithms are designed so it's like, hey, I really want to sell, so you know what I'm going to do with this algorithm? I'm going to buy first. So if you're thinking about getting into this market, like, hey, I've got a computer science background, I like maths a lot, let me get into this. Like, these algos are all about tricks. Now you can either be on one side of the trick, which is I'm trying to mask my intentions. The other side of the trick is I'm going to design an algo that can smell your algo. And if it smells your algo, then it starts to do algo things to make algo money. So Virtu is one of the most successful organizations at developing these, what I call market-making algos, where they've designed counterintelligence algos, where they can tell what's happening out there, and then they act on it. And I don't know if the streak has been broken, but they have not lost money in a single trading day for almost 6 years. Do I have any mathletes in the room? That's what we used in high school. We'd call people who are really good at math, mathletes. If you're a mathlete, that's like the professional leagues, right? All right, so it worked. This whole thing worked almost until the end, okay? So this is what happened. Eventually, the media got caught wind of this. Somebody snitched on Wall. And so the price towards the end ballooned up to $80,000 an acre. Okay? So did this work?
Well,
you think so? Almost? Who thinks it works? Who thinks it didn't? We don't have enough information yet. What do we need to know whether this worked?
what he was willing to pay.
How much the liquidity buy for it?
Hold on, wait. Yeah, here we go. High frequency trader right here. Not TWAP, VWAP. What was his VWAP price for all this? Because this 80,000 came at the end. 200 an acre. Did it work?
Yeah.
Hell yeah. This algo trade, this is like a dream. It's a dream. I just traded a truckload of this stock. The stock didn't move. In the beginning, we were talking about what is a liquid market, and I think somebody said something like, when you can trade a lot and the market doesn't move. That's not a liquid market. That's actually a market that's behaving completely abnormally. That's like a fat kid jumping into a pool and being like, I don't want to make a splash. It's impossible. The market's going to move. It's going to happen because you're expressing demand in the marketplace, or you're expressing supply in the marketplace in size. It's got to move. This definition, because people do say this, like people creating regulations, they say, we're going to measure liquidity based on how little the market moves when you trade a bunch of something. What? That doesn't define whether a market is liquid. But yeah, Walt pulled this off, and you guys are advanced already, so you guessed it. It's like TWAP or VWAP, but the answer is VWAP. But you're right, you need at least some benchmark to tell you. Right, so now you guys know how high frequency trading works. And just to tie this all back together, because I think we have like 15 more minutes and I just want to answer any questions you may have. Your placement in the order book, your ability to execute, the rule set is price, and then what's the second thing that determines where you are online?
Size.
No, price?
Size.
No. So who said it? Price and then?
Priority.
Time. Price, time, priority. Okay, so who here has heard of co-location? You've heard of, what is co-location?
Like you try to be as close to the exchange as possible so that you minimize on your transaction time.
Or you minimize on your order placement time.
Yeah, or minimize on your order placement.
So let me explain this to you, what he's saying. We are now at the point with these markets, because the rule is the person, your place online is first going to be your price, and then it's going to be time. Right? If we're going to be playing these algo war games, and I'm going to try to sniff out whether or not somebody out there has a big algo order that they're executing, my ability to make money off of that information is directly related to how quickly I can trade. And it is so related to that me, if I'm in New Jersey, sending my orders to the exchange in New York through a fiber optic cable, I'm too slow. I need my server sitting right next to the server of the exchange to cut down on the length of cable for sending this order. This is where these markets have started to go, where it's like, wait a second. So the real estate around an exchange's server, boom, huge price increases. Because people are trying to put their box next to the exchange's box, because if we both come up with the idea that, hey, there are competing algorithms out there, I've sniffed that there's a big algo order, you've sniffed that there's a big algo order, you've sniffed that there's a big algo order, I'm going to make more money than you if I'm able to get my order to the market first. And that is what is differentiating profits from closing up your business, how close you are, how quickly you can get the order in. It's turned into that race. You are now experts on high-frequency trading and on electronic order books. All right. This course actually has 10 hours. We've skipped around in it. But I hope that I touched on the things for you that at least give you some sort of edge or advantage around what exactly is really going on in financial markets. It goes a lot deeper. But if you can actually just slow the information down for yourself and first think that what I'm looking at when I'm examining a financial market, I'm looking at a cultural system. This works this way. It might not, I might be like question like, that's really weird, but it works this way because it's been culturally shaped to work this way, okay? The cultural shaping to make people co-locate is the fact that we're still behaving according to a rule set that says time is the tiebreaker if people have the same price. And now that you know that, hey, you want to fix high-frequency trading? We can fix it right now. You want to fix the problem? Switch the rules. Price size priority would fix the rules. It doesn't matter how fast you get your order there. If two people show up with if two people have the same price in the market, the order that has bigger size attached to it goes on top in the limit order book. High-frequency trading is over. Yeah?
As a challenge, then you're discriminating against smaller orders, right?
Yes, I am. But I believe in discriminating against smaller orders. And you do too. You want me to prove to you that you do? I'll prove it.
Because I don't go individually and buy it. I go to a broker who aggregates it, I guess.
Here's the thing. The large orders are actually more valuable to the liquidity providers because they allow them to actually make more money in terms of moving risk. They need those orders. So giving priority treatment to the smaller orders is killing the business. Remember, if we want a liquid market, we've got to have a lot of liquidity providers, but they've got to be compensated for their risk. And if you're making me have to respect all these little orders, you're killing my ability to make money. That's what's been really hurting the stock exchange market. But I'm going to tell you, all of you in here, I sound unfair, right? Trample the little guy. I sound unfair, but all of you agree with me, and I'm going to prove it. Here, I'll prove it. You and your friends go to the same restaurant every Friday night. Every Friday night. It's an Italian restaurant. When you get there, Mario, we're here. You get seated, and you guys eat and drink up the place, okay? It's your thing that you do. And in fact, you're late for it, so I better shut up. Okay, but one Friday you go, and I don't know what's going on. Maybe it's Parents' Weekend or something like that. There's a line around the block to get into Mario's restaurant. Are you waiting online? Are you going to wait online with everyone else? You and your friends?
Probably not.
What are you going to do?
Let's go to the next restaurant.
Oh my God. Wait, come on. Somebody who's less, yeah, what are you going to do?
Talk to the owner and play the card that I'm frequently visiting.
Play the card? You're going to go right up to Mario. Mario, we're here. We're here. And what is your expectation culturally of Mario? What's he supposed to do?
First.
Right, in the table that you sit at every time. There's this beautiful scene in Goodfellas. I don't know if everybody watches that movie, but like, first of all, it's a scene that took like 36 hours to shoot, and if you like are into cinematography, you'd realize why. But it's him showing up, the lead character showing up to the Copacabana with his girlfriend, and there's a line outside. He goes up right up to the guy, and the guy's like, "You're here!" And they fucking clear out the rest of the tables and put his table right in front of I think it's Milton Berle or something, or Benny, whoever the comedian was. That's because you and your friends showing up every Friday, you reduce the risk of running the restaurant for Mario. Why do you reduce the risk of running the restaurant for Mario? What do you do that's really valuable for Mario?
Stability of revenues.
What?
Stability of revenues.
Stability of revenues, the ability to turn over that inventory. Remember, food spoils, but you guys, you go and you eat and you drink the place up. That means that Mario has a more stable business. So if Mario doesn't keep you as a customer, he can't run his business. Parents' Weekend only happens once a year. Those parents can wait. Those smaller orders should wait. The bigger orders are actually representing the large asset managers that end up representing more of the retail public than the individuals on that order book. That's why I believe, like, yeah, they should be skipped. Yes?
So do you think that cryptocurrencies that one is going to win the market because there has to be like a price adjustment between all of the disparate trading that goes on right now?
So, by the way, right now we're just in straight Q&A, so if you have any questions for me, because we only have a few more minutes. This is what I think about cryptocurrencies. I think it's really worth your time to learn how cryptocurrencies work, because I think that the toothpaste is out of the tube. Whether or not it's Bitcoin that wins, or any of the other ones, that's not what you're here for. You're here to understand how the crypto market works, because there will be crypto markets from here on out. We're not going back. It's like somebody ignoring the internet. It's like, I think we'll go back to like looking in the freaking phone book. No. So I think that like trying to predict which one of these is going to win, that's not your job. Your job is to understand the mechanics of the crypto market, to see where the gaps are, and to see potentially where there is potential for arbitrage. You came up with one right now, right?
No, my question is, do you think one, not any one in particular,
but one cryptocurrency to win them all, to rule them all?
Because, yeah.
I'm
because
only
of this arbitrage issue, right?
No. Well, what you're not talking about is different. We're not talking about different coins. We're talking about different market centers.
Yeah.
And I would say no. Historically, if you look at it, what ends up technology, just like Expedia, somebody's going to aggregate all of the exchanges and make it so that when you want to trade Bitcoin, your price is going to, when you put a bid or you put an offer out there, it's going to be respected across all of the exchanges. And so when if somebody, for example, on Gemini wants to sell, even though your bid is on Coinbase, their order is going to hit your bid first. That's the central limit order book concept, where all these limit order books are out there. Somebody's got to centralize them. So no, there won't be just one dominant exchange. As I said, like in the equity market, there are 40 different electronic liquidity pools. For years, the New York Stock Exchange tried to be the only game in town. And they actually wrote a lot of papers around how the monopoly of them being the only game in town lowers the overall rents for all market participants. Bullshit. So it doesn't happen that way. What really happens is we've got enough technology to route. And that routing technology is milliseconds. Other questions? Yes?
So I want to go back to the dark pool and algo trading. So if large institutions can trade in dark pool executing large orders, why do they still need buy-side algos to execute in the exchange?
I love it. Okay, because here's the thing. There is that's something called a natural liquidity solution. There's a natural buyer and there's a natural seller, right? So basically what you have is you have two liquidity buyers meeting for a trade, right? I'm looking for an opportunity to buy, you're looking for an opportunity to sell, and we meet. That's awesome, let's high five. But that, mechanically, if you think about it, is the equivalent of you deciding that you're going to hitchhike to school every day. That mechanism is not reliable enough. You're going to try to trade on some days in a dark pool, and there won't be anyone on the other side. Just like you're going to try to come to school one day by hitchhiking, and nobody's going your way. And so ultimately, every single market, and please, just like I'm telling you, like everybody, when people get into like market structure and they start thinking about technology, they think if I could just network the market better and everybody knew what was going on, there would be no need for intermediaries or liquidity sellers. Who in here believes that? Does anybody believe that you can basically hit a market nirvana where intermediation costs go to zero and there's nobody intermediating. There's nobody actually in the business of providing opportunities to trade. Well, it's never really happened in a meaningful way in any market ever. I'll give you an example of how you could. Like, if you wanted to sell your apartment and you didn't want to pay for a broker, what could you do? What would you do with your apartment?
Market it yourself.
Market it yourself where?
Street easy.
Street easy? Craigslist, right? You should probably make sure that you've got a good headshot for a milk carton if you're going to be marketing on Craigslist, right? You can do it yourself. And in fact, if you've got a two-bedroom apartment on the Upper West Side, you can actually get it done that way. Because why? What's the most important force in any market? It can determine how markets move?
Transaction frequency.
Transaction frequency. What's probably the most frequently traded apartment in the entire New York metropolitan area?
Central Park.
Well, a two-bedroom apartment on the Upper West Side. You've got the most high-rises, right? Two-bedroom apartments, like the most standardized. The amount of people out there who really want to buy and sell two-bedroom apartments is high. I'm listing all the elements here. And then the natural demand, like, you're kind of balling with a two-bedroom apartment, right? Even if you only need one bedroom. Right? You're kind of balling, as everybody wants that. So it's like, it's got the most amount of those elements. So from a frequency standpoint, you may be able to get it done through Street Easy or through Craigslist. Absolutely. But if you had like a 4-bedroom apartment next to Central Park on the east side, the crowd size isn't big enough. You're now at a price point in a marketplace. In fact, if you could just think of the real estate market, if you're really balling and you're going to be selling like, I don't know, like a $10 million apartment, are you putting that on Craigslist? Are you using a broker, a regular broker? You are? Because Sotheby's handles that. There's a model that's appropriately applied to the actual product based on the transaction frequency in that product. The things at Sotheby's, they don't trade that often. And so Sotheby's is basically providing liquidity, right? The service of convenience, because they're getting all of the rich people that can afford that apartment in the room. So that's a service they're providing for the people who want access to these apartments. And the people who are trying to sell those apartments, they're going to get the best possible price because Sotheby's has organized the market for them. So it's not impossible for you to see these completely networked markets. I would just tell you that the intermediation costs don't go all the way to zero. There's always an intermediary, regardless of how frequently traded something is. It just keeps on getting smaller and smaller and smaller and smaller. So you absolutely could, if you wanted to, try to do a complete no cost, no broker. But if you have the wrong type of product that you're trying to sell, it's not going to work very well. It's going to be suboptimal for you to actually get the thing done in any reasonable amount of time. Any other questions? Yeah.
But for securities like stocks, right?
Yeah.
It's like essentially like uniform fungible. You could do decentralized exchanges which are popping out right now in the crypto world. Where, I don't know if I understood it fully, but there are ways to completely.
Yes, you could, but let's go back to the mechanics here. We're talking about Microsoft. Is the frequency of trading Microsoft in 100 share lots higher or lower than the frequency of trading Microsoft in 100,000 share lots? Much higher. So that idea you have may be completely appropriate for trading really small pieces of Microsoft consistently. But if somebody was going to try to trade really big blocks of Microsoft, I can just tell you that mechanically, like the all-to-all decentralized, just everybody meet each other, it has never really worked mechanically. Well, to me, just in terms of like what I've looked at and reading about market structure, modern market structure, what you are suggesting is similar to somebody saying, I think an ostrich may fly one day. There are reasons, mechanical reasons why it hasn't worked that way, and it hasn't been for lack of effort. People have been trying it and trying it and trying it, and I don't think it's a technological reason. I think it's a cultural reason, because it's like, this is really big, really important, and I need to make sure that I know who I'm dealing with. We talked about it before, like, You know, if me just saying that I want to trade 100,000 shares of Microsoft, I've got to make sure that I only tell people who I can trust will not disturb the market for me. That there's the cultural practices around trading size. So I don't mean to be dismissive of the idea. I can just tell you that, like, show me the historical context, because there's one thing, and never forget this. Human beings have been on this earth, the modern human, like, for hundreds of thousands of years. There are lots of people who are much smarter than us, who have tried things, like, just to give you an example of this, like smarts, we still today, with all our modern technology, cannot figure out how the Egyptians built the pyramids. That's why, like, those Ancient Aliens, I love those shows, because it's like, hey man, that's just like the default, like, I guess somebody just beamed down and built this, because we still can't figure it out now. Clearly that's kind of ridiculous, right? So I'm just saying, like, the idea that you have, like, people have been trying it, try to find the source material around other people who have tried this using that theory and what happened. And I think that you'll kind of come to that conclusion after a while, like, there's something mechanical here that's a problem. All right, I think we're done. It's like, in Friday time, it's like 8:30 at night. So I really appreciate your patience, and nobody fell asleep, which is kind of a record. I'm really passionate about this stuff, so if you have more questions, I'm happy to answer them. I think my contact information will be somewhere around. But you can easily look me up. ViableMkts.com is my company. And thank you for your time.